Fed has to reiterate its commitment to its inflation target.
The Fed is still on an easing path, even if it's going to be slower.
It's going to be a very tumultuous 2025 if we continue down this path.
The Fed has done a lot of work getting us off of ground zero.
No forecaster, public or private, knows where we're going to be in 12 months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend, to Christmas, to the year end, to all of the above. From New York City this morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now on a 3-day slide on the S&P 500 coming into Friday, a 3-day losing streak. Equity futures on the S&P down again. We're negative by 0.8% on the S&P 500. On the Nasdaq 100, we are lower by 1.3. On the S&P, a record streak of negative breath.
14 straight days of more losers than gainers at a time, where people are wondering, is this just this respite, sort of the take back before early next year when they're expecting some sort of boom? A question now, though, of whether there has been a shift in tone because of the Fed, given that we aren't necessarily going to get that inherent easing bias throughout 2025.
We talked about this a lot yesterday, how we were set up going into that Federal Reserve. Let's go back to the start of this week. Feels like a long time ago. Bank of America put out their Global Fund Manager Survey, called it super bullish. Record low allocation to cash, record high allocation to U.S. equities. That was the setup to that hawkish shift from the Federal Reserve on Wednesday.
That's really important, and I think it's really great that you bring that up, because at a certain point, can we really say that this is a dramatically different tone from the Federal Reserve, or just simply a market looking for any excuse to take a breather after such lofty heights? Look at some of the biggest losers over the past couple of days. They are the likes of Tesla. They are the likes of Bitcoin. They are some of the largest gainers post-election, that maybe the froth is just coming off the top.
Let's head over to Europe. Euro dollar right now bouncing off a 2-year low. Euro dollar 103.90. Europe's got enough problems. Here's one more. Donald Trump, President-elect, out on Truth Social. I told the European Union that they must make up their tremendous deficit with the United States by the large-scale purchase of our oil and gas. Otherwise, it's tariffs all the way.
Okay. I read this and then I looked back and I was like, wasn't there a pause, a ban on the licenses to sell LNG over to Europe? Oh, yeah, that's right. This administration. This is a Europe that has faced fickle U.S. policy when it comes to whether they want them to buy their LNG, their liquefied natural gas, or not, whether they want them to really be taking up some of the resources. So here's the question. How much does Trump actually effectuate this with respect to jawboning Europe versus just increasing production in the U.S. at a time where backdrop policies have been shifting and back and forth over the past couple of years?
So here's the good news for the Europeans. The Europeans are already there. Ursula von der Leyen came out as soon as Trump won the election and basically said, we'd like to buy more liquefied natural gas. This is what they want. Here's the bad news. I don't think that's going to be enough to close the trade deficit. You're going to have to do a whole lot more than that. So that's where I think there's going to be some space for a little bit more tension in the years to come.
Well, and the tension increases because the dollar is so strong. So any exports from the U.S. are going to be incredibly expensive for a lot of these places. Meanwhile, I just wonder how much cohesion there is among the Republicans themselves at a time where they can't really get themselves together and keep the government open so clearly. So a real question here about what policies actually do get passed.
Are we really going to get shut down going into the weekend?
I honestly have no idea. The good news is they took a 1,500-page bill and they took it down to 116. They took out some of the wage gains for some of the Congress members. The bad news is that they couldn't get a lot of their Congress members within the Republican Party to sign off on it. And basically, you have the situation where House Speaker Mike Johnson came out and said, if any of you can do better, please have at it, because that was his message.
I'm happy they've sliced up the bill, and this is why. They can all stop pretending that they read bills, and they can actually start reading them. Because there is no way that these people read those bills that are that long in like this amount of time, just days. There's no way they do that.
Okay, but that was the only thing that they accomplished. I think that Representative Chip Roy, who is a conservative from Texas, really put it well when he said to congratulate yourself because it's shorter in pages, but increases the debt by $5 trillion is asinine.
Anne-Marie down in Washington, D.C. a little bit later this hour. She'll join us in about 15 minutes' time. If you're just joining the program, welcome. Equity futures on the S&P 500 adding to the slide. We're down by 0.8% on the S&P. The good news, I guess, for the equity bulls in a bear market, in a bond market, at least we're not climbing any higher for 10-year government bond yields. Yields are lower by just 2 basis points on a 10-year, 4.5362. Coming up this hour, we'll catch up with Joe Quinlan of Merrill and Bank of America, remaining cautiously bullish. We'll speak to Doug Rediker of International Capital Strategies as a US government shutdown continues to loom, and Christian Wetherbee of Wells Fargo as FedEx plans to spin off its freight division. We begin this hour with stocks falling as traders weigh the threat of a US government shutdown and await the last major data point of the year. Joe Quinlan of Merrill and Bank of America Private Bank remaining bullish, but proceeding with caution. Stickier than expected inflation and therefore fewer Fed rate cuts than anticipated could cause the bull market to stutter or stumble. Joe joins us now for more. Joe, is this a stutter or a stumble?
I think more of a stutter, John. I mean, actually, I thought this was going to happen in January. We moved it up before Christmas. So, the stickier inflation theme is something that our economists have been talking about for quite some time. We saw through the numbers. We got the PCE later today. So I think this is a wrestling match that we're going to have to deal with over the course of 2025. But look, inflation is not 2%, but it's under 3%. So that's a nice place to be in terms of the overall market.
So, Joe, the Federal Reserve is increasing their inflation forecast. You saw that on Wednesday. They had to adjust the dot plot off the back of that. I just wonder whether that reshapes your view of how much risk you want to be carrying into 2025.
It didn't change anything really, John, in the sense that we've got a good economy, good consumption. If you could convince me this economy was going to slow down dramatically for whatever reason, we changed our bullish outlook. But look, we've got good employment. We've got a CapEx cycle underway. Higher income households are still out there spending. So you've got a good nominal growth, which means you've got a good backdrop for earnings. We're still looking for earnings around 13% year over year in 2025. That hasn't changed.
At the same time, Joe, because we've taken some of the froth off the top of some areas that had been the high flyers, does that make you more bullish?
It makes me more comfortable, Lisa, for sure, because for the last, say, a week or so, our clients have just been flabbergasted by the enthusiasm in the markets, and they've become increasingly worried. So this pullback, I think, is refreshing. It sets us up for a better, healthier 2025, whether it's January and February. So no, I take comfort in this pullback because, there's some sanity to the market in terms of some of these valuations and the over-enthusiasm.
I'm going to use that, Joe, throughout the day when people talk about the sell-off and how concerned they are. I'm going to say it's refreshing. That's what Joe Quinlan said. It is a refreshing sell-off. I do wonder how you sort of weigh the backdrop of a U.S. government that may shut down with haggling over whether or not they get their first raise in a decade and also just the number of pages in the bill. I'm wondering, does that register in the sort of different panoply of risks that you're looking at?
Not really, Lisa, in the sense that you know this as well as I do, as do investors. Government shutdowns, they've happened before. We know the script. They can be hours, they can be days or weeks. They're going to reopen. We're going to get the continuing resolution. We're going to pay our bills. So, yeah, it's drama that we really don't need in and around the holidays, but it's here. And if we do shut down tonight, they've got the weekend to work through. Hopefully, they're open by Monday. So it doesn't really fundamentally change our view. But, like you said earlier at the outset, if we went from a massive bill down a few pages, maybe that's progress. Maybe we count the progress by the number of pages of the bills.
That might be where we are, Joe. I'm not as worried necessarily about a government shutdown and how long it takes for them to get the government open. There's a bigger point here, which is some people were saying that with a red sweep, there would be a faster path to policymaking. Actually, a quicker and more effective Donald Trump administration to pass some of the more growth-oriented policies, given the fact that a host of different Republicans did not vote for this bill and did not go with the president. How concerned are you that that whole case that's been baked into some of the optimism isn't reality?
That was part of my note I put out about what worries us into 2025, because you have to realize, the gears grind slowly in Washington, right? There's a New York minute and there's a Washington minute, and they're night and day. So absolutely, Lisa, we've been talking to our clients. Listen, when it comes to the tariffs, anti-immigration, corporate tax reform, you name it, this is going to take months, if not quarters, if not all year. So kind of curb your enthusiasm. We have it built into our expectations, some of our asset allocation. But you're dead right in the sense that the gears there are just not as fast as Wall Street. There's a big difference.
But Joe, just to jump in, sir, if I may, you can get the tariffs done a whole lot quicker than you can get the taxes done, just by definition.
You can, John, but even that takes time to like layer in and get implemented. But you're right, for sure.
Sure. So they're going to come out January 20th and potentially start doing it almost immediately, saying we're going to do 1, 2, 3. Is that the sequencing that you expect? Because sequencing seems to be important to a lot of investors for next year and beyond.
I think the sequencing is going to be important, but also the targets, right? If we're going to come right out of the gate and go after China, how does China react? That's going to be important. You talked earlier about Europe. So I think, you will know the priorities of the administration right out of the gate. And everyone does expect it to be China. But then, John, then you got to go, okay, what products, how much, what industries? There's, a lot of U.S. companies are working behind the scenes with the incoming administration, to go easy, to protect what they have in terms of their supply chains. So, yeah, it's going to be very interesting, but I don't think it's going to happen overnight either.
Hey, Joe, good to hear from you. Enjoy the holidays. Merry Christmas, sir. Joe Quinlan there of Merrill and Bank of America Private Bank on the latest. It looks like the focus at the moment seems to be on tariffs and spending cuts, based on where the focus has been over the last few weeks.
And as you point out, tariffs might be a lot easier to get through than, say, spending cuts, if cutting down the number of pages of a bill might be the progress, but not necessarily getting that bill passed.
I'll tell you one thing losing some weight this morning. It's the market cap of Novo Nordisk. That stock is getting absolutely hammered. We're down by 22%. Let's get you an update on that and more with Yahara Hacker. So, Yahara.
Hi, John. Yeah, shares of Novo Nordisk plunging the most on record. The company reporting people treated with its experimental obesity drug, CagriSema, achieved a weight loss of 22.7% after 68 weeks. That's below the 25% weight loss Novo previously said the drug could deliver. Eli Lilly shares are getting a boost on the news, up more than 10%. And President-elect Donald Trump is threatening the European Union with tariffs if they don't increase their purchases of American oil and gas. The EU is already a major buyer of U.S. liquefied natural gas and has discussed purchasing more to deter tariffs. EU officials and member states have been bracing for a trade offensive ever since Trump's election victory last month. And Bitcoin is falling today. The price now lower by over 10% from its record high of $108,000 reached just this week. The downturn also impacting smaller tokens like Ether and Dogecoin. Some investors are opting to take profits and reduce exposure following the Federal Reserve's hawkish pivot on Wednesday. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Equity futures on the S&P. Very much close to session lows. We're down by 0.8%. Up next, a looming government shutdown.
Very disappointing to us that all but 2 Democrats voted against aid to farmers and ranchers, against disaster relief, against all these bipartisan measures that had already been negotiated and decided upon.
Fun and games into the weekend. Anne-Marie down in Washington, D.C. has a whole lot more from New York City this morning. Good morning. Three-day slide on the S&P 500. Make that day 4. Equity futures right now negative by 0.75% and poised for a second week of losses on the S&P. Yields have been grinding higher through the week. We pulled back 2 basis points now. The 10-year 4.54. Under surveillance this morning, a looming government shutdown.
Very disappointing to us that all but 2 Democrats voted against aid to farmers and ranchers, against disaster relief, against all these bipartisan measures that had already been negotiated and decided upon. Again, the only difference on this legislation was that we would push the debt ceiling to January of 2027.
So here's the latest. This is how things stand. The Republican-led House rejecting a temporary funding plan backed by President-elect Donald Trump, setting the stage for a potential government shutdown, with government funding set to lapse tonight unless a new solution is found. Douglas Rediker of International Capital Strategies writing, there are real political issues around members of Congress and senators heading home for the holidays while the government is shut down. If the government shuts down, Social Security payments continue, but pay for federal workers, including military personnel, cannot be made. Doug joins us down in Washington alongside Anne-Marie. Anne-Marie, good morning.
Good morning, John. It looks like we are headed towards that shutdown at midnight this evening. Doug, is that correct? Are we going to be shutting down the government before the holidays?
Unless there's some strike out of the blue, which in the Trump era, or I should say the Musk-Trump era, could happen. But right now, I don't see any path to 218 and then to the Senate and then to the president's desk.
What are the options right now on the table?
Well, I mean, there's Plan A we know didn't work. Plan B didn't work. There is no Plan C. There's some talk, I think, about going back to Plan B. So the bill that didn't pass last night, going back and trying it again. I don't know why, the Einstein thing about, if lunacy is doing it, same thing and expecting a different result. I don't think you're going to get 38 Republicans to change their votes overnight on the same bill. So I don't know what the path is. I think the easiest path is probably just a very clean CR. Just say, let's just go home for the holidays. Let's deal with this in January. Let's at least keep the government open. But even that is, a very, very tough lift at this point.
But Hakeem Jeffries and the Democrats already negotiated that Plan A package. Would they go along with a clean CR?
I don't know. I think that if it were really clean, so it's literally the definition of a Washington kick the can down the road. You take all of the issues other than just continuing to keep the government operating, and you say, let's do this next year. I suppose theoretically that's better than, telling people that they're not going to get paid over the holidays. But, despite the Republicans' efforts, I do not see that the Democrats are getting blamed for this. This is purely in the camp of the Republicans.
So one of the biggest spanners that was thrown in the works was Donald Trump coming out and saying, you need to raise the debt ceiling. And he's now on the same side as some Democrats who for years have been calling to abolish the debt ceiling. Yesterday, I agree with President-elect Trump, says the senator from Massachusetts, Elizabeth Warren, that Congress should terminate the debt limit and never again govern by hostage taking. Could you see under a Trump administration, maybe if it's not now, abolishing the debt limit?
I would love to see it. I think the debt limit is always this looming, ridiculous specter where, as we know, it's not about spending new money. It's about paying for things that you are borrowing to pay for things that you've already appropriated and spent. So it makes no sense to have the debt ceiling in our legal system, our governing system. Having said that, this is probably not the time to do it at the last minute, 11th hour, throw it in. It's unrelated to the CR as it was constructed. So could I see this happening in the next Congress under President Trump? Sure, they've raised it. It's now out there. But, of course, in the past, these things have been quid pro quo. You don't get something for nothing in this town. And it's hard to see, even if you say I want it, that you're going to get it without giving something else up from the other side.
Where's the president on this issue? He's been
Which
very
president?
silent.
President
the current
Biden.
president.
Okay. Yeah, he's very silent. A part of me yesterday was saying, my God, man, you're the president of the United States. You've got to weigh in. If the government actually shuts down, it's on your watch. And then part of me said, when your opposition is digging a hole, you let them keep digging. So I guess I'm sympathetic to the idea that Biden doesn't have the political capital to spend to actually contribute to this, which is a sad indictment of the presidency unto itself. But he's nowhere, and I guess he's going to sign whatever's put on his desk, and I think that's too bad, but that's the reality.
But we're talking about workers getting furloughed, VA benefits potentially not going out. At some point, does Biden need to step in?
Well, the question is, would it be helpful or not? Right? This is right now all about the Republicans. As I said earlier, they're trying to indict the Democrats and say it was the Democrats' fault. It's a very heavy lift when 38 Republicans in the House voted against this to blame the Democrats for this. This is really the Republicans owning it. If Biden steps in, there's at least a chance that some of that political spill gets onto his watch. He's probably just saying, over to you.
Okay, so what does this mean for Speaker Johnson, January 3rd? Does he get the gavel back?
Yeah, I think the only reason Speaker Johnson gets the gavel back is because either no one else wants it or it's just fundamentally impossible to get the majority of the House the entirety of the House Republicans, the majority of the House to vote for anyone else. So he got it the first time, not because he was everybody's first choice, but because they went through 1, 2, 3 different candidates, all of whom failed. He was the easiest guy to get through that didn't offend as many people as everybody else. That might be his ticket to success again in January.
Without a speaker, Congress cannot function.
Yep.
And Donald Trump cannot get through his agenda. Once they are able to function, though, I want to get your take on what are you telling clients on how they should think about next year, the sequencing of tariffs, immigration, and tax cuts?
Yeah, I think tax cuts, as we're seeing, are going to be hard. We know that there's a discussion about whether there would be one reconciliation bill or two. The entire fiscal policy is clearly something that doesn't have internal consensus within the Republican Party, much less across both houses, both parties. You might not need that in reconciliation, but even within the Republicans, that's hard. So I think taxes are going to be a later in the year kind of thing. I'm a believer that Trump, when he says something repeatedly, as he has on tariffs and immigration, that he means it. So I'm expecting early on, whether it's day one or week one, that there will be major moves on immigration and on tariffs. And I think the markets generally are underappreciating the risks of both of those.
So on tariffs, he truthed last night. I told the European Union that they must make up their tremendous deficit with the United States by the large-scale purchase of our oil and gas. Do you see this is how Trump is going to do deals? You buy this from us, we won't be as harsh when it comes to tariffs?
Yeah, well, that's the transactional Trump. And to some degree, the logic of what he just described is pretty strong, right? So we know that Europe has been long too reliant on Russia for its energy. Obviously, the war in Ukraine has made that a much harder lift. The U.S. has an enormous amount of LNG capacity that we can export. Of course, there are some logistical issues. You need to be able to import it. You need to have the terminals, and you need to have the processing. But let's just say this makes sense. Doing it as a threat, doing it saying either do this or we're going to throw tariffs on you, is probably not the way the Europeans are going to respond the most favorably. But the logic behind what he's saying is there, assuming the U.S. is a reliable supplier of LNG and other energy products. But this is not necessarily the method that the Europeans are going to respond to.
Right. Although Ursula von der Leyen did come out days after Donald Trump was elected and said maybe we'll buy more U.S. LNG. The issue is, of course, is Biden put a permit on LNG that is still in place. So is there even enough supply in the United States to get more there? This is going to take a while.
Yeah, so it's going to take a while, but there are a lot of excess LNG capacity in this country. Again, there's a logistical problem. There is, as you described, certain permitting issues. I'm not sure that we have as much as Europe needs to replace everything that it gets from everywhere else. But, of course, nobody's going to replace everything with one source supplier anyway. So there is enough LNG that American suppliers could probably make investments if they knew they had long-term contracts, and Europe was going to agree to those long-term contracts. The problem with LNG is, to some people, it's a clean energy. To others, it's a not clean energy. And so longer term, are you boxing yourself in to buying an energy supply that is going to end up being unacceptable to the population of Europe, which is very green-focused?
But at the moment now, the United States is number one when it comes to LNG exports, imports into the European Union. Russia is number two. So I think the United States probably would say we should have a bigger chunk of that pie. Okay, so overnight he talked about tariffs with Europe. Previously, in the last few weeks, we heard Donald Trump talk about tariffs with Mexico, Canada, and China. Does he do all of these at the same time?
So Trump has used tariffs as both a means to an end and as an end. Right? So if they are an end unto themselves, that's when he talks about how you can raise, billions, trillions of dollars on the back of tariffs that are costless to Americans. Basically, his model in that way is we put tariffs on things, other countries pay it, and you, the American consumer, don't suffer any costs either through higher taxes or through higher prices. I don't believe any of that is true, but let's just say that's the way Trump thinks about it. The other is as a negotiating leverage tool. And that's where we are right now. The 25% on Canada and Mexico is stop immigration, stop the flow of fentanyl, and I'll rethink this threat about 25% tariffs. On China, we don't know what he means, because the 10% is a more modest tariff threat. China could probably absorb that relatively easily through, amongst other things, devaluing the renminbi. And the bigger threat out there is the 60% tariff that he's threatened against China. I think probably he'd love to sit down with President Xi, cut a big deal. I don't know what that would look like. President Xi is a different President Xi than he was 8 years ago. Trump may or may not fully appreciate that. So I think that there is, in Trump's mind, two conflicting uses of tariffs, as a means to an end and as an end unto itself. He can't do both.
Doug Rediker, thank you so much for your time. Jonathan, that was the managing partner of International Capital Strategies, Doug Rediker. As we await this potential shutdown, it looks like it's going to be happening this evening at midnight.
AMH, thank you for the update. We'll catch up with Anne-Marie in the next hour. Across a few things this morning, we are not going out quietly, are we, into the new year? Novo Nordisk getting hammered. We're down by more than 22%. An experimental obesity shot, losing less weight than predicted in a study. That stock's getting hammered. Eli Lilly, up in a pre-market by close to 11%. More on this story in just a moment. Coming up shortly, we'll also catch up with Jordan Rochester of Mizuho as Trump threatens the EU with tariffs. Coming into Friday, a 3-day losing streak on the S&P 500, the longest losing streak going back to October. We're down again this morning. We're negative by 0.8%. We're down 1.3 on the Nasdaq. We're down 1.4 on the Russell. The small caps getting hammered. In the bond market, 2-year, 10-year, 30-year. We'll focus on the 10-year portion. Yields are down by 2 basis points, but they are up on the week by about double digits. The 10-year, 4.54. It's just not the shifting perception of the Federal Reserve and a drop of the easing bias. It's also the data, Lisa, this week. S&P Global PMI, retail sales, jobless claims, consumption numbers, GDP, data's been pretty good.
Which is now putting a renewed focus on inflation over employment, which is the reason why PCE, that key data point for inflation that the Fed tends to look at 8:30 today, might actually be pretty interesting. If it surprises to the upside, how much does this really re-emphasize just a hawkish tinge that we heard from the Fed?
Yields on a 10-year in a place we haven't seen since late May. Let's turn to foreign exchange. Off the back of those moves that we've seen in the bond market, the dollar a whole lot stronger against the euro through the week, against the Japanese yen. Dollar yen has had a 2% move this week. We're back to 157. It is a third week of yen weakness and dollar strength.
And did you see the fact that Japanese inflation came in hotter than expected? You just start to wonder, why aren't they raising rates? They have inflation that's surprising to the upside. They have basically a currency issue where they want their yen to decline or to actually appreciate versus the dollar. Is it just simply that they want the tourists?
Possibly. You were one of them, weren't you? Or at least a family member was.
A family member was, but I would be an aspiring tourist.
I have to admit, I've checked out some of the hotels. I've had a little look.
This is my shock face.
Around 160. I've been thinking about
really?
it. Yeah, okay. Why not?
Just to experience?
Out of all the countries in Asia, Japan, I would love to go. And I'd never been.
Everything's in its place. There are lots of
very
procedures.
Precise.
Exactly.
Culturally, everything's in order.
It's totally your speed.
It just feels like my kind of vibe.
I agree.
Dollar yen right now, 156.78. Let's get you some stories. Under surveillance this morning, shares of Novo Nordisk plunging the most on record. The company reporting people treated with a new experimental obesity drug lost 22.7% of their body weight. Sounds good, but it's below the 25% Novo previously expected. Eli Lilly shares getting a boost off the back of this news. Big rally there, Lisa. We're up by 9%.
So basically, you've got Eli Lilly versus Novo Nordisk in this war for weight loss drugs. Mounjaro is the one for Eli Lilly, and Novo Nordisk has theirs that now is raising questions about who can lose the most weight. It's sort of like who is the biggest loser. This is sort of the debate between the two. This is a market that surged to some $24 billion just in 2023 alone, and it shows just how much is at stake. It also shows the dominance of some of the high flyers because the Danish stock market is experiencing its worst day in a very long time because that's where Novo Nordisk is based.
It's the second biggest weighting on the Stock 600, just behind ASML. The Stock 600 is lower by 1.7%. We'll stay on top of this story through this morning. Elsewhere, the US government inching closer towards a shutdown. The Republican-led House rejecting a temporary funding plan backed by President-elect Donald Trump, with 38 Republicans voting against it. Government funding set to lapse tonight at midnight. Another big story going into the weekend.
So there are a lot of questions here. First of all, as we were hearing from a number of different analysts, what's new about a government shutdown? We get them pretty much every time this comes up, which is the reason why President-elect Trump wants to actually do away with the debt ceiling. There is a question, though, about what this means for next year. If 38 Republicans are going to vote against this, if one of the hardliners, Chip Roy of Texas, says that this is asinine to just simply shorten the bill in pages, but still increase the deficit by $5 trillion and say you're making progress, it highlights a level of uncertainty around how exactly they're going to cut the deficit. Cutting the pages isn't enough.
I've seen a lot of criticism of the likes of Elon Musk, people coming out and saying Elon Musk is running the government. Hold up. Let's take a big step back. We have a sitting president. His name's not Donald Trump. His name's not Elon Musk. Where is the President of the United States on this issue? Anne-Marie asked the question down in Washington moments ago, where is President Biden?
Yeah, basically, and Doug Rediker saying, what does he have to come into this, right? Is he going to be held responsible if the government shuts down, considering the fact that, for all intents and purposes, President-elect Donald Trump has already taken the mantle? He just isn't in the White House yet. And that sort of, it raises this question of, well, can this government function without actually a sitting president?
Anne-Marie joining us in about 45 minutes' time to try and answer that question, because I'm going to punt. President-elect Donald Trump threatening the European Union with tariffs if it doesn't buy more American oil and gas. The EU has already talked about purchasing more fuel from the United States, which is the world's largest producer of crude oil and the biggest exporter of LNG. Bloomberg's Ollie Crook joins us now out of Berlin. Ollie, we all remember Ursula von der Leyen coming out very quickly and saying, yes, give it to us. We're ready to buy it. Do you think actually this is a place we can make some deals?
Yeah, I mean, I think absolutely, John. I think there's both bad news and good news in this sort of message that we got here. I think the bad news is for European policymakers is getting back to this idea of this sort of truth social newswire being fired up 1:08 a.m. Eastern time. This comes out as sort of a bomb to the Europeans. The good news is that this is totally aligned with European interests, totally aligned with what Europe has been doing for the last 3 years. You look just at natural gas. They've tripled their volumes of imports from the United States since the invasion of Ukraine by Russia. We've got about 50% of all of the LNG that comes into Europe now is already coming from the United States. The other good news, John, is that we've had this sort of abstract idea of 10%, 20% tariffs to close the trade deficit between the United States and Europe. Now at least the Europeans know what Donald Trump wants, what can be done to sort of avoid this. And just to tie in another story that we got significantly over the last 24 hours, there is this Ukraine-Russia gas transit deal. There's still about 50 billion cubic meters of gas that flows from Russia into Europe. That deal is now dead. That is a sort of deficit of 15 billion cubic meters. That's about 10% of what Russia used to send before the war. That is another thing that could be closed by this gap. And just a final point on this, John, I think this is actually maybe one of the most interesting parts about this. He says he told the European Union. Who did he tell? Who is Donald Trump in contact with? Is it Viktor Orban? Is it Olaf Scholz? Is it Ursula von der Leyen? Who is going to be the sort of power broker in this new sort of geopolitical architecture? That, for me, is one of the main questions here.
Ollie, forgive me, but when I read this from Donald Trump, I thought to myself, isn't this what everyone kind of wants? That there was, except for maybe Joe Biden, when he put a pause on some of the licensing for LNG exports to Europe. I mean, Europe wants to export more LNG from the U.S. U.S. producers want to export more to them. Does this really have to be sort of, I'm going to tariff you if you don't eat your candy?
Yeah, I think the way that Will Kennedy, our sort of editor on energy, put it is that this is sort of pushing an open door, right? This is something that basically everybody is sort of aligned on, everybody wants to do. I think that, from that perspective, I think that there's going to be basically very little resistance here. This is going to be easy wins for a number of governments. They need to secure that sort of energy pipeline. There's no way that they're going to continue to get some of this Russian gas. There was all these discussions about basically could that Russian gas go through Azerbaijan, then Azerbaijan sells its gas into Europe. Basically, all of those concepts are dead. So again, you still have another deficit that needs to be plugged, and it is plugged most easily, most conveniently, and most sort of conveniently from a geopolitical standpoint now to gain favor with Donald Trump by buying more American.
The Italian flag in the background suits you, Ollie. Ollie in Brussels, by the way, not in Berlin. A change of scenery for him going into the holiday period, Lisa.
Really, that's immediately where your eyes go.
Just the Italian. That was a beautiful thing.
Yeah, it was great.
Just trigger some patriotism.
That was the reason I saw him. Please zoom in, just frame right there. And then that was the only thing. I know, you orchestrate these things.
Jordan Rochester of Mizuho joins us now for more, not on that. On this, the EU will be hoping this is the same political theatre as 2018. I would argue that hope is not a plan. And LNG imports won't address the size of the US trade deficit, but it's the best the EU have got to work with. Jordan, welcome to the programme, sir. Jordan, news or noise when you read that statement?
It's news, because if you think about it, John, and Merry Christmas, by the way, good to see you. If you think about it, we've had Trump come in, winning the election. He targeted Canada, Mexico, and China. And I noted to clients, mysteriously absent on the rest of the world, Europe, Japan, the rest of Asia. And he started to pick them off one by one as time has gone on. We've had India this week, and now we've had the EU today. And as I put in the note to clients, the tricky thing is if he's serious. If he's serious, the EU can definitely buy more LNG. But the problem is they won't at all be able to plug the deficit with the US just from LNG alone. Oil might help as well, but I think oil's pretty much maxed out too. If you look at the LNG purchases the EU has made from the US, it's already half of EU LNG imports. It's a fantastic achievement. And the exports of LNG from the US have been ramping up a lot over the past 5 years, but they can't double in the space of this 1 year period, I would say. And they're annualizing around $26 billion a year in what the EU buys from the US if it was to take all American LNG exports. So it's just really difficult for the maths to add up. So in answer to your question, it's news if he's serious, because the EU, won't be able to negotiate a deal on behalf of other members. Juncker didn't have that power, neither does Ursula von der Leyen now. And what Juncker did in 2018 was a political charade, really. It was a memorandum of understanding. It wasn't a trade deal. It was just a sort of loosely worded statement saying we'll buy more LNG and soybeans. Well, they have. And Trump's still complaining. The deficit has gotten wider since the EU has actually already increased their LNG purchases. So if he's serious, the maths doesn't add up and tariffs come into place. But I think perhaps, John, he's giving them a way out to do the same they did in 2018 with a memorandum of understanding, and maybe he avoids tariffing Europe to begin with. But it's all down to human decision at the end of the day, John.
Jordan, let's take this story and push it through foreign exchange, as we often do. We've already had a 5% move on euro-dollar, weaker euro through this year so far. Is this another reason, in a long list of reasons, to keep selling the euro?
Yeah, there's a long list of reasons to keep selling the euro. It's like cats and dogs. You've got what's going on with the tariff situation. You've got what's going on with European macro. The industrial recession in Germany just keeps getting worse. In the short term, we've had services strength in Europe keep us in doubt about how far the ECB can cut rates. But I think the services sector will turn lower next year. It's just so difficult for services to do well if you're laying off your manufacturing employees, as Germany and others are doing in Europe right now. So we've got 101, so near parity in euro, John. But the key message from my side, John, is that's a view into January the 20th. And I think the inauguration is an event risk in itself. It could be a day where we get a list of executive orders in the afternoon from Donald Trump. If tariffs do not feature in that list, if he doesn't start a sort of investigation into raising tariffs on others, it could be a buy the rumor, sell the fat moment. And that's why I think 101, we price in maximum pain. And then if it goes more smoothly, if there's not a significant tariff hike on day one of his presidency, perhaps it's mean reversion. And this market likes to mean revert, and the dollar sells off from there.
In the past, the dollar has sort of had a self-correcting mechanism where if it gets too strong, things start to break, and then suddenly weakness takes over and there is this normalization. At what point do you see that risk coming into play?
Indeed, it ties to the FOMC response function. Typically, you have a big sell-off in equities. The FOMC kind of rides out for a bit, but when you have a 10% drawdown, they tend to circle the wagons and reverse course. I think that could be the case. It feels a lot like 2018 to me, Lisa. Remember 2018? We had a pretty hawkish Fed. We had a 10% sell-off in the S&P 500, and then we got to January, and Powell changed his sort of mood music quite quickly in just public statements, and we had most of that sell-off come back in the first part of January 2019. So we could be in for a case of that sort of story. I'm not calling for a 10% drawdown, but that's the sort of pain threshold where you get the Fed members responding and perhaps changing their language. But it's really difficult because the macro data supports a much more hawkish Fed. We've long had a 4% terminal as our view at Mizuho before Trump won the election. A lot of people joined us in that race to 4% once Trump was elected. But we're now pricing that pretty much perfectly in the rates curve. So it could be the case, Lisa. I think the risk reward is we actually price in a little bit more cuts than what's now in the market. I think we should be at least pricing a cut by March or June. There's about one cut by June, but March is around 50-50. And so we should see some curve steepening on the back of it. 2s, 10s looks really interesting here.
We've talked about two different issues, whether it's the tariffs and just the Donald Trump risk to potentially a weaker euro, stronger dollar. And then there's the Fed response mechanism. Which do you think is in the driver's seat?
Well, I think the Trump trade is in the driver's seat for everything in January. It all boils down to that. And then once we know what's happening with tariffs, it's done. It's essentially the information's in the market, and then we go back to following what the inflation data says, what the GDP data says. And it's just difficult for the Fed to be dovish when you've got GDP at 3%, and they're now casting even a bit higher than that. You've got inflation reaccelerating on the month-on-month numbers, and tying this into the LNG story. Have a look at natural gas prices at Henry Hub. They're at the highs of the month. They're rising in a fashion that could bring energy services CPI as a problem next year for the Fed. So altogether, Trump's in the driving seat trying to push up LNG exports, pushes up domestic prices. It's inflationary as a policy. And then you've got the situation with tariffs, which of course are inflationary. I suspect they'll stagger the tariffs, though, over a year to try and reduce the knee-jerk reaction from firms having to raise prices as soon as the news is out. And we're hoping to see, or we're probably going to see, FX depreciation in China and all those other currencies such as the euro to help offset the impact of any tariffs if they come in. So if you have the 60% tariff on China, that's a huge piece of news. That's definitely in the driving seat right now.
Last question then, Jordan. Year to date, if I go on the screen on the Bloomberg terminal and have a look at where things are at the moment, everything in G10 is weaker against the US dollar, including the Japanese yen with a 10% move. When I do the same thing at the end of 2025, is that screen going to look any different?
Good question. I think it will look different. As I say, I think we actually get dollar weakness by the end of next year, but it's dollar up for the next quarter and then down from Q2 onwards. I think you will see the yen strength come back in as we're still in a rate hiking saga from the Bank of Japan. And you will see the economic data improve. I'm an optimist, John, for the second half of next year. We've got all this monetary easing. We've got the potential for China fiscal stimulus in Q2. We should be seeing a weaker dollar when that happens. So we've got euro bouncing back to 105. But it's such a mild rally. I'd focus more on the sort of story for the dollar right here and now.
Got it. Jordan, Merry Christmas, sir. Thanks for everything this year. Appreciate it. Thank you, buddy. Jordan Rochester there of Mizuho, looking for further dollar strength at the start of 2025, and then the weakness starts to kick in. You start to look for the policy shifts in places like China and beyond.
So Hotel Tu Nishinotoyan Kyoto has space for you in February if you want to take advantage of this window.
What's the hotel like?
It is beautiful looking.
Yeah,
wow.
good food?
The food looks amazing. It looks like, actually, it has a good variety of not just Japanese food. Look, I'm being kidding.
You're being sincere?
Well, I'm saying that basically if it's going to go to 160 and then it's going to be the other way around,
make a move now.
I think that's the reason why people have all been traveling to Japan.
That's where TK is at the moment.
Is it?
Yeah.
Can you imagine
Took
him?
a long weekend after the Federal Reserve decision.
He definitely seems like he would enjoy taking his shoes off, sitting down, cross-legged at a table.
He's a sushi kind of guy. Loves it. Equities right now on the S&P, negative by 0.8% on the S&P 500. With your Bloomberg brief, let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. President Joe Biden is expected to announce new plans to cancel student debt for about 55,000 public sector workers, totaling more than $4 billion in forgiven loans. This move brings the total number of individuals who have received relief under the Biden administration to nearly 5 million, with a total of $180 billion forgiven. Easing the burden of student debt was a key promise of his 2020 campaign. Meanwhile, China's bond market is rallying on expectations of policy easing in the country and demand for safe haven assets. One-year bond yields are now trading at their lowest level in over 2 decades at about 0.9%. You have to go all the way back to 2009 to see these levels. The stars seem to be aligning for this year's rally to extend well into 2025. Amid speculation, China will make deep cuts to interest rates to bolster its economy against the threat of more U.S. tariffs. And a big win for Boeing. The plane maker has secured a $36 billion order from Turkey's Pegasus Airlines. The carrier placed orders for 100 not yet certified 737 MAX 10 models, with options to order another 100 more. It will begin receiving the jets in 2028. While it's a big win for Boeing, it's a major blow to its rival Airbus, which was the previously preferred choice for the Turkish airline. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in about 30 minutes' time. Up next on the program, a FedEx spin-off.
FedEx Freight is the most profitable part, that they've got. It's small, but it's growing. Generally, this is a good business from a macro point of view. But FedEx, as a bigger story, is always a bit about something other than the economy.
The latest on that company up next on the program, live from New York City. You're watching Bloomberg TV. Whatever happened to that Santa rally? It's breaking down right now. We're negative by 0.9% on the S&P 500. 3 days of losses into Friday. Could become day 4. In the bond market, attracting just a little bit of a bid. Yields are lower by 2 basis points. The 10-year 4.54. We're at levels we haven't seen, Lisa, since May, following the Federal Reserve and better than anticipated economic data in America.
It raises the question of how much was this actually a shift from the Federal Reserve and how much was this just sort of an acceptance that the higher inflation that we've been seeing truly is higher inflation that could affect how much the Fed is willing to cut next year.
Under surveillance this morning, one stock in particular, a FedEx spin-off.
FedEx Freight is the most profitable part, that they've got. It's small, but it's growing. They've got some unique aspects, particularly on the southern border in the U.S., where they do well. And generally, this is a good business from a macro point of view. But FedEx, is a bigger story. Has always been about something other than the economy, or at least for the last few years.
So here's the latest this morning. FedEx spinning off its freight division into a separate publicly traded company. The Wells Fargo analyst Chris Wetherbee writing, "We believe a FedEx Freight spin into a standalone company will be viewed positively in the near term." Chris joins us now for more. Chris, welcome to the program, sir. Why is it the right time to execute this move?
Well, I think they've been thinking about the spin of their freight business for the last 6 months or so. But when you look at the comparable multiples of other LTL companies in the market, they traded a significant premium to what FedEx does. And I think by spinning this out as a standalone, they're going to be able to tap into that relative value difference, be able to see some upside for the business, which is a smaller piece of their business, only 10% of revenue, but ultimately has a significantly better margin than the RemainCo. So I think getting that access to that better multiple certainly provides a pretty big lift from a sum of the parts perspective.
Chris, can you just give us a sense of where FedEx is in its turnaround plan? Its shares are down considerably so far this year. There's been this real underperformance as they lose business to the Postal Service as well as other providers. How far along are they?
So we're technically in year 2, so about halfway through the second year of their 2-year drive program. So we've made some progress so far, about $1.8 billion of potential savings in the first year. They're looking for $2.2 billion in this fiscal year. And like I said, they're about halfway through that. They seem to be achieving it. That being said, as you noted, there are some headwinds in the market that they're facing. So we're not seeing that benefit come through as net benefit to results. So I think they are making some decent strides. We saw that in the fiscal second quarter. Their Express segment, which people had been worried about, did post better results than expected. It was the freight segment, actually, ironically, that was a little bit more challenged in the second quarter. But it does appear that they are making some results. They're making some progress here. They are, I think, affecting change where they have the ability to, but they are fighting through what is still a very challenging environment for people like FedEx and UPS who are moving freight around the world.
Chris, it's sort of shocking when I hear they're challenged by a weak consumer when so many other companies are talking about the strong U.S. consumer. Can you square that circle for me?
Yeah, I think there's absolutely some strength in the consumer freight flows that we're watching on a regular basis. Imports into the country, containerized imports have been up double digits for many of the last months of 2024, as we've seen a restocking event and a fairly resilient consumer from a spending perspective as well. I think the reason why FedEx has struggled to some degree with consumers is really the e-commerce side of it. So both FedEx and UPS don't really have as much access to the parts of e-com that are growing the most rapidly. So folks like Amazon, we've even seen some of the lower priced discount Chinese e-com players like Temu and Shein also growing very rapidly. And FedEx just frankly doesn't have access to that volume growth. So Amazon is not a customer, and they're limited in some of those other very high growth categories. So you're left with sort of the rest of e-com, which is growing faster, generally speaking, than the broader economy, but is limited to some extent. So I think that's why you're seeing this discrepancy, because as I noted, consumer demand, generally speaking, has been surprisingly good in 2024.
FedEx this morning up in a pre-market by a little more than 9%. Chris, appreciate your time, sir, going into year end. Chris Wetherbee there of Wells Fargo on the latest spin-off effort from FedEx. That stock again up by more than 9%. If you are just joining us, welcome. Equity's getting hammered right now. Ever since that Federal Reserve news conference, as soon as it started and Chairman Powell was asked about the decision, why cut interest rates at all? It was a close call. We never looked back. We've been down ever since. It's a 3-day slide into Friday, and it could become day 4. We're down by 0.9%. Up next on the program, we'll catch up with Jim Caron of Morgan Stanley. Anne-Marie will be down in Washington, D.C., and we'll speak to the San Francisco Fed President, Mary Daly. Do not miss that conversation, kicking off at about 7:30 Eastern Time. The second hour of Bloomberg Surveillance is up next.
The bull cases have gone away.
We continue to have this have and have not economy.
I think the market at every step has been worried about inflation.
There are certainly parts of the market that are very frothy.
The next couple weeks we think are going to get a little choppy here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
This is not the year-end rally you were looking for. Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now. And this is what the price action looks like. We're down again. After a three-day losing streak, you could make that day four. We're down by 0.9% on the S&P. We're negative 1.3 on both the NASDAQ 100 and the Russell 2000. Lisa, the losses are adding up.
And they're adding up in all the wrong ways, given the fact that this has been negative momentum for quite a while. We've talked about bad breath. We need to continue with that because it's been 14 straight days of more losers than gainers in the S&P 500. This was the comment from Michael Hartnett over at Bank of America. Breath, global equity breath, remains dire.
The longest streak on record, according to Jim Reed at Deutsche Bank. I've got to say, I was stunned by that. That's how bad the run has been. It's incredible.
And it shows how much it's been dominated by the high flyers. And this is creating some concern by a number of people who already have been concerned by how high things have already gotten. You put it really well earlier this morning when you said, ultimately, it's not just that the Fed came out and signaled that they weren't going to cut rates as much as expected in 2025. It's that we were coming from such a high place that was high enough to make people nervous just by virtue of no one out there being particularly bearish.
I wanted to give one analyst, one economist, one strategist some credit as well. Torsten Slok over at Apollo. We shared a quote with you from some research of Torsten's over the weekend, and it read as follows. Recent inflation readings show signs the decline in inflation has stalled, and there is a risk of re-acceleration. For investors, the risk is a repeat of 2022, where the 60-40 portfolio underperformed significantly. Is Torsten onto something into 2025?
If the current price action continues, absolutely, because what you're getting is concern that maybe yields are going to be significantly higher than people previously thought. The Fed isn't going to offer up the same level of put as they had before. At the same time, all the good news has already been baked in, and now we get to sequencing and what happens in Washington, D.C., which, as we can see, tends to be a little bit fraught.
Anne-Marie's going to join us on that in a moment. Bond yields are lower this morning by a few basis points. There's one stock that we're watching. Novo Nordisk is getting absolutely hammered over in Europe. That stock is lower by more than 16%. An experimental obesity shot, losing less weight than predicted in a study. They're doing badly. Who's winning off the back of that? Lilly. Eli Lilly up in a pre-market by a little more than 4%.
This is a heated competition between Eli Lilly and Novo Nordisk over dominance in the weight loss drug category that's been a complete high flyer. Just give you a sense of how small the margins have to be for this stock to respond this kind of way. The shot helped patients lose an average of 22.7% of their weight over 68 weeks. This is the Novo Nordisk drug versus the expectation of at least 25%. And that was enough to sink them at a time where they're neck and neck. It also sank the Danish stock market the most going back to 2022. Again, this goes back to breadth, narrow breadth. The gainers are the ones that are lifting everybody, and there's a lot of weakness under the hood.
Just to be clear, that is the Danish stock market. Like that one stock is the Danish stock market, and that ultimately is the problem for the Danish stock market.
Well, yes, and it also is telling that the Danish stock market is composed of a stock that sells significant amounts to the U.S., not necessarily to the Danes.
Number two, waiting on the Stock 600 as well. So the Stock 600 over in Europe having a difficult morning into the afternoon. Coming up on this programme, we'll catch up with Jim Caron and Morgan Stanley on the healthy sell-off in equities. Anne-Marie joins us from Washington on the latest spending fight. And San Francisco Fed President Mary Daly on the Fed's outlook for next year. Don't miss that. That conversation starts at about 7:30. We begin this hour with stocks on a three-day losing streak ahead of fresh inflation data at 8:30 Eastern Time. Traders also keeping one eye on Capitol Hill as a government shutdown deadline nears. Jim Caron and Morgan Stanley writing the sell-off in equities is healthy. Better to happen now when year-to-date equities are up more than 20% versus early January and start the year in a hole. Jim joins us now for more. Jim, welcome, buddy. It's good to see you. What's healthy about this?
Good morning. I'm sorry, I didn't catch that.
What's healthy about this? 14 days of negative breadth on the S&P. What's healthy about it, Jim?
Yeah, so look, I mean, the markets were technically very overbought. This sell-off does not represent a change in trend. As you were saying earlier on the show, there's been a very heavy concentration in a very few names. That narrowness of breadth has already started to widen out. But when you get these big adjustments and you get these expectations of earnings still coming in good, but maybe not as stellar as people had thought in the past, then I think you start to get the sell-off. Look, I mean, the S&P 500 was up about 27% on a year-to-date basis. And we owed that to a very, very few set of names. This is now starting to broaden out. And as the market broadens out, what that means is that the former winners are going to start to decline a bit. Doesn't mean it's the start of a bear market. It just means that we're in an adjustment process of broadening out the markets, moving into sectors that are more mid-cap orientated, which is our view, that we think can potentially do better from an earnings growth perspective.
Jim, did anything change for you Wednesday afternoon when Chairman Powell finished speaking?
You know, it's kind of interesting, right? Because this is the dilemma for the market. All Powell basically did, yes, he did announce a slower pace of rate cuts. The dots did move up 50 basis points across the curve. But guess what? That's almost exactly what the market was expecting. If you looked at Fed funds futures prior to the meeting, and then after the meeting, they were, they were a little bit higher, but they weren't materially higher. I think what the market's reaction is here is it's really about the bond market. So effectively, where people are starting to get nervous is from a positioning standpoint. If you look at year-to-date returns in bonds, it's in the low single digits. It's around 2 to 3%, let's say, for most of the ag indices. If you get another 25 basis point rise in yields between now and year end, which is possible, and you get a widening of spreads, many bond investors are at risk of losing their whole year in the next 2 weeks. That's not our forecast. That's not our base case. But it does create this riskiness that you could get these extended sell-offs in the market, yields rising, and that could have a negative impact on equities. So we have to put this into context and understand those technicals as well.
Jim, I'd like to dig a little bit more into that. At what point is that the reason why you're not buying bonds right now, even though they've sold off? And generally, you're optimistic about the disinflationary narrative. You still think you want to wait for a greater sell-off. What's the point? What's the trigger for you to buy?
Yeah, so look, I mean, the place that we're looking to line up and buy, really, our holiday shopping list is really going to go towards the equity market, because we have to understand why is the Fed willing to cut rates by less? It's probably because the economy is doing a bit better. That's good news for equities, right? So moving into mid caps, active over passive, materials, more cyclicals, all of that. Now in bonds, though, I think that at this level, I think this is an area where bond yields can kind of hang out. I'm looking for an overshoot. I'm looking for bond yields, 10-year treasuries, let's use that as a proxy, to move up towards about 4.75% before I would start to get long duration, extend my positions in bonds. Because at the end of the day, I still think the Fed is going to cut a couple of times next year, which means that the upside in yield for bonds is somewhat limited. And this is why when you look at a 60-40 portfolio or a balanced portfolio in equities, that it's not quite like 2022. There is some upside, potential upside, stopping of yields. We're just not in the same cycle that we were back in 2022. So I think the setup right now going into 2025 is much more healthy because it's giving you higher bond yields, potentially wider spreads, so therefore more value for 2025, and you're getting a sell-off in the equity market in areas that you maybe wanted to rebalance into in the first place, and here's your gift, here's your opportunity to do that.
So, Jim, just putting this all together, it sounds like it's overly simplistic to say simply higher yields causes the sell-off in the stock space, right? So it's not that alone can make you bearish, but that tied with the context, as John was pointing out, of the high-flying aspects of the market were really the reason why. This is a positioning move. It is not some sort of longer-standing trend. Is that right?
That's right, yeah. So we don't see this as an economic fundamental change in trend, right? We still think the labor market is reasonably strong. We still think that the retail sales data, we still think that the broad economy is still doing okay. We do not have a recession forecasted into 2025. The issue that we have in 2024, though, was that we had a significant acceleration in the earnings growth rate for many of these Mag 7 type companies in the top 10 and much of the tech. And we don't expect that kind of an acceleration in earnings for those companies in 2025. So now, because there's such a high concentration of the index at this point, as their earnings slow to a more normalized pace, then what that means is that there's a rotation that takes down the index because there's such a high weight in the index, but then it gives you the opportunity to buy other segments of the market that are more cyclical, like materials, industrials, for example, that can actually have a better earnings growth rate going forward and potentially even a PE multiple expansion. So that's what 2025 2025 is about.
Jim, just ahead of this conversation, we talked about Torsten Slok and Apollo and the risk of a repeat of 2022. Could I get a little bit more colour from you on that? The risk of that actually developing, stocks and bonds really struggling next year?
Yeah, so in 2022, I mean, we started from a very low interest rate level, and the amount that rates could rise was quite significant. We were just earlier in the cycle in 2022 for rates to rise. At this point, we're probably later in the cycle, and in interest rates, yes, they can rise. I mean, there's no question if inflation starts to pick up, but we're also not at a point here where we expect inflation to be, high single digits like we did back then. Inflation is likely just to say, well, we're not going to get to target at 2%. Maybe we'll stay at 2.5%. Maybe we'll go to 3%. And the market's not yet forecasting rate hikes by the Fed. And so I think that's a big difference, right there in terms of the bond element to this. On the equity side, what we have to recognize is that an acceleration higher in interest rates, like what we got in 2022, will bring down the present valuations of a lot of those equity assets. If we're not likely to get the same acceleration higher in interest rates in 2025 as we did in 2022, then we think the earnings setup, the earnings path for 2025, it might be a little bit more muted, but certainly still positive and still okay. So I don't think the setup is quite the same as 2022 right now.
Interesting. Jim, appreciate your time. You've been a good friend of the programme through the year and a whole lot longer than that. Thank you, sir. Merry Christmas and happy holidays. Jim Caron there of Morgan Stanley. Jim, on the bond market this morning, by the way, down 2 basis points on a 10-year, down 4 at the front end, on a 2-year at 454. Jim making a case for 475. Before we start to see some buying come in, from him at least.
Yeah, that's when he would get bullish on duration at a time where there is a real eye toward not providing losses for your investors if you're a bond fund manager. I thought that was a good point. It was a salient point about positioning at the year end, given the fact that gains have been so meager overall. Total returns of 5 to 6% doesn't give you a lot of room to work with.
Going into year end, the losses are building. We're down by about 1% on the S&P 500 now, looking to close out the trading week potentially on a real low. With an update on one single stock and a whole lot more, let's get across the Bloomberg Briefs. Yahara Hackers. Hey, Yahara.
Hi, John. Shares of Novo Nordisk are plunging more than 18%, wiping out more than $100 billion of market cap. In one of the most anticipated drug studies of the year, Novo's experimental weight loss drug, CagriSema, disappointed, with patients losing about 20% of their weight after 68 weeks. That's below the 25% weight loss Novo previously said the drug could deliver. Eli Lilly, which makes a rival weight loss medication, Zepbound, is getting a boost on the news, with shares rising 4.8%. Meanwhile, Starbucks workers are planning a 5-day strike after bargaining talks hit a snag. Employees in stores across Los Angeles, Chicago, and Seattle will walk out of unionized locations beginning today after failing to reach a deal on better pay, schedules, and hours. The union expects the strike to spread to hundreds of stores by Christmas Eve, while Starbucks claims the union prematurely ended negotiations. And the Pentagon has shipped anti-drone technology to New Jersey amid continued sightings of mysterious aircraft. The Defense Department saying they sent equipment able to both detect drones and disable them. The government has claimed most of the sightings have likely been commercial or hobbyist drones and has temporarily banned drone flights over nearly 24 areas of New Jersey. The mystery continues. That's your Bloomberg Brief. John?
Yahara, thank you. I can't believe we still haven't figured this out.
I just love this. It's sort of like, you have a big mess and someone just hands you a roll of paper towels, basically says, all right, get to it. And it sort of feels a little bit like that. We'll send you a kit.
Anne-Marie will join us shortly. She's got answers down in Washington, D.C. No one in Washington, D.C. seems to have answers.
I will say that my younger son just got a drone for a birthday present, and I said...
A big one or a small one?
A small one. I said, not a good time. He said, let's go fly it. I said, absolutely
What does he want to do with it? What's the whole purpose of owning it?
It's just kind of cool. It just flies around, goes...
It has a camera on it?
I doubt it. I'm not going to allow that.
Okay, all right. Okay, tell us more in a moment.
It's okay.
Up next on the programme, on the brink of a government shutdown.
It is, I think, really irresponsible for us to risk a shutdown over these issues on things that they have already agreed upon. We will regroup and we will come up with another solution, so stay tuned.
Stay tuned. That conversation up next from New York. This is Bloomberg. I am right there with you. We want a quiet end to the year. We're not getting one. We're down 1% on the S&P 500. The losses are piling up. 3 days of losses into Friday. This is day 4. We're down across the board. On the S&P, on the NASDAQ, on a Russell. At least the bond market is picking up some slack. Yields are down by 2 basis points. The 10-year 4.5362. Under surveillance this morning on the brink of a government shutdown.
It was just last spring that the same Democrats berated Republicans and said that it was irresponsible to hold the debt limit, the debt ceiling hostage. What changed? It is, I think, really irresponsible for us to risk a shutdown over these issues on things that they have already agreed upon. We will regroup and we will come up with another solution, so stay tuned.
So here's the latest going into the weekend. Government funding set to expire at midnight tonight, setting the stage for a potential shutdown after the House voted down a stopgap bill backed by President-elect Donald Trump. 38 Republicans joining a chorus of Democrats in voting against the measure that would have suspended the debt ceiling until 2027. Anne-Marie joins us now for more down in Washington, D.C. AMH, is it shut down on going into the weekend?
Yeah, it certainly looks like we will see a government shutdown. The question now is whether or not it'll be short or potentially be longer. How much into January potentially could this go? Some Republicans are saying shut the government down till January 20th, the inauguration. A lot of questions that we're waiting for answers today. This hour at 7:45, we will have Vice President-elect J.D. Vance with Russ Vought, who's going to be the director of the OMB under Donald Trump, meeting in Speaker Johnson's office, according to Punchbowl News, with House Freedom members. And these are the individuals that voted this down, that do not want to see an extension of the debt ceiling. That's potentially where we can get read some tea leaves into what can come next. But they're all in a really tough place right now because in order to get an agreement through, Speaker Johnson is going to need Democrats to vote for this if the House Freedom Caucus members are not going to go for it. And the Democrats already agreed with Speaker Johnson on a bill that then President-elect Donald Trump said he doesn't want to see go through. So Speaker Johnson is in a really tough place. And, of course, all of this is coming right ahead of the holidays.
Anne-Marie, we've seen the pictures. So the previous bill was this fat, and now the new one is about this fat. What got taken out of it?
Well, a lot of extras got taken out of it. There still was some disaster funding, but things like an increase for a pay rise for lawmakers was taken out. But more interesting, Jonathan, what was added? An extension of the debt ceiling, which is why you have Representative Chip Roy, a hardcore conservative, saying, sure, it looks much tinier, but you're adding $5 trillion to the national debt by doing this. So that is why you had these 38 Republican members come out and defy their speaker and President-elect Trump.
Anne-Marie, what's the takeaway in terms of the negotiating style of Trump and Elon Musk as head of Doge when it comes to where the eliminations will happen? That same Congress member also said that it would increase the deficit by $5 trillion. Is that true? Is that what we're seeing?
Well, when it comes to Elon Musk, what we're seeing him is wield his own platform, X, to put a ton of pressure, not just him alone, but also ramping up pressure from conservatives alike on this platform to put pressure on their lawmakers to vote against the bipartisan agreement Johnson got done. Elon Musk, though, was just here in Washington, D.C. with Vivek Ramaswamy, talking to Republicans about Doge and ways they can decide that they are going to cut spending. The issue, of course, is this is just supposed to be, yes, some extras were added into it, but it's just supposed to get them through March. So many Republicans felt like we can get through March, and then in March we can start enacting our agenda. It doesn't look like they're going to be able to get through 2025.
Meanwhile, Anne-Marie, a lot of people are looking to go away. This was supposed to be a quiet end to the year. A lot of people are going away for the holidays. What does this mean for travel?
It's a great question. The TSA administrator tweeted yesterday that this could have impacts on Americans who are traveling for holidays. They say that TSA, part of DHS, about 59,000 of the agency's 62,000 employees are considered essential. So the majority of their workers are essential, and they'll continue to come to work, but they will not get paid. So you have these people going to work. They're not going to get paid ahead of the Christmas holidays. And then the TSA administrator went on to say, while personnel prepared to handle high volumes of travelers and ensure safe travel, please be aware that an extended shutdown could mean longer wait times at airports. that is really going to get the backs up of most Americans.
Anne-Marie, we have a president. I've got to finish here. Where is he?
Well, I think, you could just say crickets. He's pretty much absent when it comes to this debate. I asked Doug Rediker that question in the last hour, and he said, well, which president are you talking about? And I asked him, why is Biden not getting involved in this? And he says Biden just doesn't have the political capital right now to do so. We have yet to hear from President Joe Biden yet, and we are going into the holidays, and potentially the government is going to be shutting down, which means employees will not get paid. We've only heard from Karine Jean-Pierre, his press secretary, who said Republicans need to stop playing politics, and they said they should keep their word. A deal is a deal.
I get that these transitions, Anne-Marie, can be awkward, but this seems very awkward. There seems something very unique about this transition at the moment and the absence of the president. And it feels like also that people are actually starting to begin to speak their mind in a way when they perhaps should have several years prior. Are we starting to see more and more people come out and talk about how absent the president has been, not just over the last few weeks, but over the last 4 years?
Absolutely. There was really a damaging report yesterday in the Wall Street Journal about how absent, how in and out the president has been, and how the team around him have changed and shifted his schedule to make sure he was able to carry out his duties as president and commander-in-chief. And I think you're just going to hear a lot more of these stories going forward.
Honestly, Anne-Marie, this is something that's really a rising concern at a time where we can't necessarily get anything through. I want to finish on the idea of Donald Trump hoping to get rid of the debt ceiling limit, this idea that a lot of Democrats have been talking about. I'm just wondering, at what point do you see this as being plausible, given the fact that this shenanigan causes everyone to roll their eyes and most people would like to see it end?
I think a lot of people would like to see it, and Doug Rediker said himself he would love to see it. It's a pretty awkward day in Washington when President-elect Donald Trump and Elizabeth Warren are lining up on the same issue, and she tweeted that she agrees with Trump that they should just abolish the debt ceiling. The issue is, if Trump wants to get this done in his next 4 years, he would need Democrats to vote alongside with him. So he's going to have to give them something for that. And that likely would be some sort of spending measure that they're looking for. So potentially it could happen. You can never say never, but it would require a serious negotiation. And the Democrats would have just some leverage going into that.
Anne-Marie, appreciate your time. We'll catch up with you later. AMH down in Washington, D.C. It's going to be difficult to get things done in Washington. Whether you have a red sweep or not, it's hard to get things done.
Which raises this question about whether the hopes that people have and have baked into a lot of the optimistic outlooks for next year are warranted, right? Whether they've all been sort of prematurely baked in and now we get down to sequencing and we can actually get through Congress. I do think this is important so that we can figure out whether this is a healthy sell-off, a welcome sell-off, one that is refreshing, or whether it's one that highlights the perilousness of how far this market has gone on just a handful of names.
It's healthy if you haven't been in it. It always is, right?
Well, it's healthy if you haven't been in it or if you've been looking for... Yeah, exactly. That's exactly it. People want an entry
Super
point.
healthy from that perspective. If you've been riding high all year, less so. We're down by a little more than 1% on the S&P 500. Up next on this programme, do not miss this. The San Francisco Fed President Mary Daly on the fight against inflation and the outlook for 2025. Lisa, the Fed speak begins in about 4 minutes' time.
And this time around, it is probably the most important it's been in a long time as we seek to clarify what the different tests are that different Fed members have to evaluate whether policy is restrictive, whether they need to cut again, or whether they have to start thinking about even a hike.
20 minutes with the San Francisco Fed President Mary Daly just around the corner. From New York, this is Bloomberg. The opening bell 2 hours away. Equity futures on the S&P 500 session lows. 3-day losing streak into Friday. It looks like day 4, guys. We're down by more than 1% on the S&P. On the Nasdaq, we're down by 1.6. On the Russell, by about 1.2. With some movers. Your morning movers is Manus Cranny. Good morning, Manus.
Jonathan, good morning. Yeah, that looks a little bit more brutal as we go into the close of business. Novo Nordisk. If you want to understand what happens when you have a new experimental drug, and it doesn't hit the benchmark of what you told the market you were going to do in terms of weight loss, you lose around 22.7% if you use CagriSema. That is their new experimental weight loss drug. But the benchmark, Jonathan, the benchmark was up here at 25. So if that's what you told the market that this drug would deliver, you wipe out $120 billion worth of market equity in one fell swoop, down by $120 billion at one juncture. This is about market share, fending off Eli Lilly against you. This whole family of drugs is going to be worth $120, $130 billion by the end of the decade. So it's about defending the moat around your product range. Nike, the ghost of John Donahoe, lives over Nike. This is FedEx. We'll come to Nike in just a moment. My apologies. Divide and monetize. You've got FedEx ready to hive off the freight unit. We reckon it's worth $38 billion. That's according to Bloomberg Intelligence. But the canary in the coal mine, even though we're up 5.5%, that's on the monetization of breaking off that piece of the business. Weak demand here in the United States of America in the express business. How do we get to Nike and the ghost of John Donahoe? This is what we've got for you, down 7.6%, because Elliott Hill has come in as a new CEO. He's missed his Adidas moment, which is just tank everything. Just get rid of all of the stock. Draw such clear blue water between you and the former CEO. That's what the Bloomberg Opinion column are talking about. And the guidance here for Nike, low double digits. So Elliott Hill didn't take his opportunity to just tank everything that he has out there in terms of stock. He has gone on a world tour to mend the fences with the wholesalers. Not enough today.
Donahoe's getting a hard time. Still, Nike's down by 7.8%. Thank you, Manus. Appreciate it. More from Manus in the next hour. Under surveillance this morning, lawmakers on Capitol Hill rejecting a funding deal backed by President-elect Donald Trump. The U.S. government on pace to shut down at midnight tonight. A group of Republicans voting alongside Democrats saying they will not suspend the nation's debt limit until 2027.
The point here and the headline here is that 38 Republicans voted against this bill. So if people were looking for cohesion under the leadership of Donald Trump, that is not becoming evident. It really speaks to a messy year next year in terms of how fast certain policies can really get through.
Never mind a messy year next year. Messy finish to this year.
Well,
it's not where a lot of people want it to be, is it?
I did not want to hear what Anne-Marie had to say. Anne-Marie, take it back. that some of the air traffic controllers, not the air traffic controllers, the TSA members are going to potentially not be getting paid.
I know.
Which could slow getting through the airport if this goes on too long. That is a crisis.
As soon as you've got some skin in the game, you start to care a whole lot more, don't you?
Okay, well,
I know,
well
it's
said.
real. Let's turn to this story. US diplomats meeting with rebel factions now in power in Syria. Those meetings include talks with the group HTS, which is officially labelled a terrorist organisation by the United States and other countries. The meetings coming after the overthrow of longtime leader Bashar al-Assad. Elsewhere, shares of FedEx rising in the pre-market. The shipper announcing a plan to spin off its $30 billion freight unit. Executives saying this will allow FedEx to focus on its core businesses of express and ground shipping. Analysts expecting the spin-off could unlock $20 billion in shareholder value. That stock is up in a pre-market by more than 6%. Turning to the Federal Reserve, cutting interest rates by another 25 basis points this month, but signalling the path is unclear for 2025. Fed Chair Jay Powell saying he feels good about the economy, but we are in a new phase in the fight against inflation. I'm pleased to say that joining us around the table, alongside Mike McKee and us, is the San Francisco Fed President, Mary Daly. President Daly, it's good to see you.
Nice to see you.
Thank you for giving us some time. Let's start with the forecast. Some controversy around the forecast. I'll go through the controversy. We don't speculate, we don't assume, we don't guess. And then a month later, it felt like there was some speculation and some guessing about policy next year. I just want to talk about your approach to the forecast. Was it about the data for you, or was it about the incoming administration?
It's about the data. It's always about the data for me. We don't know what the incoming administration is going to do. You know, new administrations, no matter when they come, always put a slate of programs together. And really, as a policymaker, I want to see the net effects once I see clarity about what those policies will be. So I was focused on the incoming information and what it means for the outlook. And today, I feel like we've got policy in a good place, the economy's in a good place, and we are prepared for whatever comes before us.
What happened in the past 3 months that caused the Fed and perhaps yourself to be much more concerned about the stickiness in inflation?
Well, the data happened. And you look at the data, and what's happened is that there's two things that have occurred. First of all, the economy remains in a good place, and the risks to the outlook are equally balanced between a risk to inflation or a risk to employment. That's where we wanted our goals to be. And we adjusted policy when we had confidence that inflation was heading down, and we adjusted policy some more to ensure that we have a balanced labor market that continues. So that's where we are. But then the data on inflation have been coming in a little slower. I wouldn't even say sticky or stalled. I would say the progress has just slowed relative to what we had wanted. But that's a typical pattern. It's bumpy. As you get to the, from 2.5 or 2.8 to 2, it's just a bumpy path. Go ahead, please.
But at the same time, some people were wondering if there was this stickiness. And I'm looking right now at, say, the Cleveland CPI now, and it actually has ticked up for the month of December from November. There was this question, why did the Fed cut it all?
Sure, and again, I'm going to reassert that it's bumpy. Remember earlier in the year, we had 2 months of data and people said, oh my gosh, it's reaccelerating, and then we had it come down. So inflation data, you can't focus on 1 month or 2 months. The most important thing for me was that we needed to recalibrate policy. I saw this as a close call. Was 75 enough to be the recalibration we were looking for, right-sized policy to meet the economy we expect, or do we need more? Ultimately, I determined that the 100 basis points was really the right level. Now I feel we've got that recalibration phase behind us, and we're in the next phase. And the next phase is really looking at the incoming information. We can return to a more typical pattern of gradualism for the Fed. We've practiced that where with a lot of uncertainty, you adjust the policy rate, then you wait watchfully, and you see what transpires, and then you make further adjustments. That's the phase I think we're now entering.
From September, the expectation in the markets was going into every meeting that you'd be cutting. Has that changed now? Should the expectation be that you won't be doing anything at any particular meeting? And from that question flows a second question. What are the criteria that you need to see to decide to go back to cutting rates?
Well, as you saw from the SEP, the median projection is 2 rate cuts next year. So that's already not every meeting or every other meeting. That's 2 rate cuts. I was very comfortable with that median. That makes sense to me. But we have to remain agile. I mean, the thing that's got us here is being resolute to achieve our dual mandate goals. Price stability was our focus when inflation was very high. The employment has come into the frame so that we're focused on both. But then we also have to be agile. The world is uncertain, so we pencil in 2. And, as that estimate or that projection gets further from when we made it, the accuracy of it probably falls. And so we're just going to continually take in more information, consider it, and every meeting, your listeners should think about this, every meeting is live from the standpoint that you're debating, you're discussing, you're thinking, what's the right level of policy? But my projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
When we went into the cutting cycle, you were out front and saying you were concerned about the labor market and that we needed to make sure that we didn't lose the gains that we had. Now, absolutely, at least coming out of Chairman Powell's press conference, it sounds like the focus has shifted to inflation again. Are you comfortable with that as this new phase that he's talking about?
Well, I think of it as a new phase as well, and I would characterize it slightly differently. I would say that for a long time, a persistent amount of time, protracted, we were focused almost entirely on inflation. That's because the labor market was quite robust and inflation was 7, 6, 5. That was the right way to focus. Then the labor market came into the frame. That didn't mean we turned our focus totally to it. It just meant that after a long period of focusing only on inflation, we were now focused on both. I think that is still the case, but I see policy as already in that position where it's supporting both. The policy is restrictive. It's going to continue to bring inflation down, and it's going to do so in a way that doesn't strangle the labor market, break it, and then give people lower inflation, but take their jobs. And that's not what we're trying to do. We're really working towards that soft landing.
Merrill, you've used the word we a lot when you talk about what's happening at the Federal Reserve. We've had some people who are quite critical of the Federal Reserve and Chairman Powell's performance specifically in this news conference. One excuse that was given was that maybe he was struggling to reflect the lack of a consensus on the committee. How much diversity of thought, disagreement is there on the committee? You call it a close call for yourself. But was there some disagreement on the committee at this meeting?
Well, I'm not going to speak about the entire committee. When I say we, I stay focused on the things we all agree on, which is price stability and full employment, on our efforts to get there. What I would offer is that we have, in my mind, the healthy level of discussion and disagreement. You don't want an FOMC that thinks exactly alike. And I believe that what people are looking at is the fact that now the world is more uncertain and people are debating and bringing in their views, and that's appropriate. When it was a pandemic and there was only one direction to move interest rates, we had to do it quickly, it was obvious everyone agreed. When inflation's high, there was no disagreement, right? We're all marching up. Now you should expect more disagreement, more differences of opinion, but they're always framed to the same thing. How do we get inflation to 2 and restore or keep full employment?
When I hear the world is more uncertain, a lot of people hear, well, that's not about the data, that's about the incoming administration.
I would disagree.
Why would you disagree?
Because we have a variety of risks that are the ones we always deal with, right? The housing inflation. Right now, there's a substantial housing imbalance in the United States. The models and our data and our past experience all say housing inflation will come down, but we are uncertain about that, right? It hasn't come down as quickly as the models would have predicted, and so that's an issue. The labor market and consumer spending and growth are much faster and stronger than people would have predicted at this point, given the tightening we've done. There's a lot of uncertainty about the natural rate of interest. Where's the stopping point? And then, of course, there's geopolitical risks, the risk to global growth. That's going to be the backdrop, and then you have a change in administration. So I would say this level of uncertainty is normal in the sense that we've had all those things going on, and it's not as excessive uncertainty as after the pandemic, the financial crisis. Those were really big periods of uncertainty. So I think if you're a central banker, you just get used to uncertainty and you manage it.
Before we get into what some of the uncertainty about next year could look like, I am curious about how you're weighing how to preserve the job gains with the risk of running the economy hot for too long. And that's, I think, something people are struggling with. Is there an emphasis on the labor market, even at the behest of inflation, just because it's been deemed better for inflation to be a little hotter as long as people keep their jobs?
Yeah, I would characterize it a little differently, but that is a terrific question. And it's one we spend, as you know, Reserve Bank presidents spend a lot of time in the field, working in our district. I have the whole Western United States. And so I asked people the question, where are you on this? And again, I hear that the economy is sort of in a good place, right? Inflation's coming down, it's gradual, and the labor market is solid, but there's one job for every unemployed worker. That's in perfect balance. And our firms are saying we can find workers, and our workers are saying we can find jobs. And no one really wants that to break. So what people do not want is a recession. And I think one of the reasons sentiment's been rising since the middle of this year is because the recession risk is now behind us in people's minds, and they feel good about that. So what I hear more than you would think is don't get 1/10 off inflation and then break the economy. That's like, we can be patient, but you just have to head for 2, and we don't want the economy to break.
That's why I thought it was interesting that the inflation forecast for next year was shifted upward, even at a time where the unemployment rate was shifted downward. There was a sense that that was okay to have 2.5% inflation at the end of next year, even though it was above 2%. Is that the sort of feeling right now on the Fed, to be more patient with inflation because it's thought of as less punitive at a level below 3% than, say, a rise in unemployment?
Well, let me just say how I think about it, because here I will speak for myself. I'm not comfortable with the rate of inflation being 2.5, but we're continuing to work on it. And so we might end up cutting rates less if inflation is as sticky as that. But what I'm also balancing is I don't want to see an unnecessary rise in the unemployment rate just to get a quarter ahead on the 2% goal. So that is a balancing act. And I think ultimately we were just looking at the information coming in and saying, there's a lot of risks out there. Inflation could rise. But you'll see, the inflation rising was partly why you saw the rate cuts pulling back. Is if we had 4, you'd see inflation go up more. And so this is a balancing act. But I think it also points you to the dispersion that you saw in the SEP, which I see as a feature, not a bug. You should have some dispersion when the world's uncertain. Otherwise, you would wonder if we're all in an echo chamber. But we're not. You can see that clearly. And you see the dispersion. And I think that dispersion really represents what we're facing. We might end up with fewer cuts than 2. We might have to respond and end up with more if inflation falls faster or you see a significant weakening in the labor market. And I'm comfortable sitting in that center court position and waiting for the data to come in, and we'll agilely respond as they do.
Well, do you think there's any chance that you might have to raise rates next year?
You know, I don't see that on the horizon right now, but we will always remain prepared to do what is needed to achieve our goals. But I don't see that in the span of the most salient risks right now that I face. But, you know, absolutely, that's something that we never take off the table.
Who owns the dot with no cuts next year? Come on, reveal. Whose is that in 2025?
Reveal.
Not going to tell us.
No, I'm not going to tell you. I'm no rookie, you know. I'm rookie.
Just seeing how far I can
It's not
push
a holiday gift I'm willing to give you.
Okay,
kidding?
all right, I'm just checking.
Reveal. That was subtle.
President Daly's going to stick with us, I'm pleased to say. Thank you. Mike McKee, thank you as well, sir. The San Francisco Fed President, Mary Daly. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Heckes. Hey, Yahara.
Hi, John. Tensions are building between Amazon and the International Brotherhood of Teamsters. The union called on thousands of Amazon workers to walk off the job yesterday and is now warning more Amazon workers would go out on strike in the near future, just ahead of the holiday delivery rush. In response, Amazon says it's filed unfair labor practice charges against the union. Meanwhile, U.S. Steel shares are falling nearly 6% in the pre-market. The company warning its fourth quarter earnings will be lower than expected as steel prices remain depressed. It anticipates adjusted earnings before items of about $150 million, falling significantly short of the over $260 million Wall Street expected. Wall Street analysts are taking this opportunity to say this underscores why a deal with Nippon Steel would be beneficial. And iPhone maker Foxconn is putting its interest in Nissan on hold while the Japanese automaker continues merger talks with Honda. Former Nissan chairman Carlos Ghosn tells Bloomberg what Nissan's potential merger with Honda means for the struggling automaker.
They have cash problem, they have investment problems, they're being really hammered in the United States, they got practically out of Europe, they're being challenged in China, and there is no plan in front of it. So I can tell you that means there is panic mode inside Nissan.
Excellent interview. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate it. More from Yahara in about 30 minutes' time. Up next on the programme, weighing policy uncertainty.
Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting.
We'll dig into that next on the programme, live from New York City. This is Bloomberg. Welcome back to the programme, live from New York. Equities at the moment on the S&P attempted to bounce off session lows. We're still down by 0.9%. Under surveillance this morning, weighing policy uncertainty.
Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation.
So that was Fed Chair Jay Powell admitting multiple FOMC members weighed policy uncertainty in their economic forecast. The San Francisco Fed President, Mary Daly, is still with us. President Daly, you were all about the data, not about the administration change. We do want to talk to you about how you would approach changes in policies from the incoming administration, though, across many dimensions: immigration, taxes, but the big one, I think, for many, tariffs. What's your approach going to be next year?
So we have all the tools and evidence from past historical periods. We can think about how these things will affect the economy. You know, one of our biggest tools of figuring out how things will affect the economy is talking to CEOs of small, medium, and large companies, and we've already been engaged in doing that. So when we're out there in the field talking to people from across the country, and I'm spending my time in the 12th District, we're hearing that their sentiment is up. They're really optimistic, that they've been cautiously optimistic. They see the Fed's interest rate path falling, and they feel good about that. They see the economy as the recession risk is behind us, and they feel positive in general about some of the things that they think may change going forward. Now, whether that materializes or not, we will wait and see. But I feel that sentiment alone is causing us to have some enthusiasm, some cautious enthusiasm, if you will. One thing that we hear is that for firms that are worried about the immediate impacts of tariffs on their business, they're just building up some inventory so that they can have some insurance. And so that's something you'll start to see in the data already. But I haven't seen that in such an outsized way that I think it's going to change the course of the economy.
One thing that you say, President Daly, is that we have experience from the past of tariffs, of some of the immigration bans or limits. But is this time more difficult just because of where we're coming from? It is a more inflationary time after a pretty big stimulus package injected into the economy.
You're feeling like an economist, like when you think of state dependence, right? The impacts of policies are affected by the state of the economy. So one thing that is on my mind is that we already have inflation above 2%. And so we have to work hard to get inflation down to 2%. And that is an economy that's just a little more vulnerable than it would be if we had inflation, at 2%, or when we came in to the tariff discussion or trade discussions last time, it was below 2%. So I feel on the other side, the real side of the economy is very strong or solid. And so we're in a good position, but it is on my mind that inflation's already elevated.
Well, does that make it that tariffs are more likely to be inflationary than they have been in the past?
It's really hard to say. I mean, one of the things you learn from doing this kind of a job a while is that it really depends on the scope, magnitude, timing of tariffs, and whether our companies in the United States are positioned to use substitutes and manage. And you see this happening. We already went through another feature that might make it less challenging is that in the pandemic, firms reshored, nearshored, friendshored, and you saw a lot of that behavior already taking place. So we'll see.
We just have about a minute, but in being agile, how concerned are you that people are going to label decisions as political?
I don't feel concerned about that. I think what we've done well is talk to the American people. The chair does that in his meetings. We do that. And we're telling them we are only focused on inflation and full employment. Those are the goals Congress gave us. We're going to do our best to navigate the incoming information, whatever causes it, and make the good decisions, make the best decisions, and then be humble about having made the wrong one or the right one and redo it. And think about it again. So that's how we're going to approach it. And I think ultimately people will judge us by whether we're successful.
You've been generous with your time this morning. We
Thank
appreciate
you.
it. Enjoy the holidays.
Happy
Thanks
holidays.
for being with us. Thank you.
Bye-bye.
That was Mary Daly there, the San Francisco Fed president. We will look at the politics. Donald Trump, the incoming president, on Truth Social. If there is going to be a shutdown, let it begin now. That's the message from the incoming president. We'll catch up with Anne-Marie in the next hour, so look out for that. Also joining us coming up on the programme in the third hour of Bloomberg Surveillance, we'll speak to Matt Miskin of John Hancock, Zachary Waring of CFRA, the brilliant Kathy Bostjancic of Nationwide, and Subadra Rajappa of SocGen. The third hour up next.
Fed has to reiterate its commitment to its inflation target.
The Fed is still on an easing path, even if it's going to be slower.
It's going to be a very tumultuous 2025 if we continue down this path.
The Fed has done a lot of work getting us off of ground zero.
No forecaster, public or private, knows where we're going to be in 12 months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
At the end of the year, you want to wrap things up, sort of calmly go into the night, enjoy yourself, enjoy the holidays, and then bang. Washington, D.C. happens. We're heading towards a government shutdown. This from the incoming president of the United States, Donald Trump. If there is going to be a shutdown, let it begin right now. Here's the quote. If there is going to be a shutdown of government, let it begin under the Biden administration, not after January 20th under Trump. This is a Biden problem to solve, but if Republicans can help solve it, they will.
And this is basically him saying, look, if anything does happen, it's not me, it's him. He's still in office. Remember him? He might not be coming out, but he is still there. There is a real question about whether this will actually politically be designated to him, whether it will be ascribed to the Republicans. I don't want to get into that. It's almost the year end. Are we done with these games and noise? If it continues long enough to stymie holiday travel, it doesn't matter who is to blame. There will be a lot of anger.
Fox News reporting a little bit earlier on that the House could vote on a temporary fix to the shutdown at 10 a.m. Eastern time. So we'll see if we're getting more detail on that over the next few hours or so. Anne-Marie's down in Washington, D.C., so look out for an update from AMH a little bit later. Who owns this? You decide. Who owns this sell-off? Let's get into that. Equity futures on the S&P 500 down. We're down across the board once again. A 3-day slide on the S&P. We had some weight to that move. We're negative by 0.8%. In the bond market, Bramo yields are lower by a basis point or two. The 10-year 4.54.
You ask a question, who's to blame for this? Who can we ascribe the guilt for taking away the Christmas rally that wasn't? And basically, a lot of people are saying it was a toxic brew of a Federal Reserve that came out with a bit more of a hawkish message than expected, as well as just simply angst about how high valuations are. I think it's important to note that not only have valuations been really elevated, but there's tax time selling, there's this recalibrating of portfolios, and then there comes a time with low liquidity when there isn't a lot of conviction. So that's why we might have seen the worst weekly drawdown going back 3 months.
There's been some huge debates this week around the Federal Reserve. One in particular, the forecast. Was it about the data or the incoming administration? Mary Daly, the San Francisco president, on the program with us just moments ago, making the point that for her, it was about the data. And on the incoming administration, I thought that when you started to question the president from San Francisco about tariffs, it was interesting to me that she hadn't drawn any conclusions over how inflationary incoming tariffs and tariff increases would be. I think that's an important approach.
This is really one of the big debates. People say tariffs are going to be inflationary because if you tack a tax onto certain goods, then it probably will get passed on to the consumer. The experience back from the previous Trump administration was people bought fewer of those items. That's what leads to actually a slowdown in the economy. This would be a much different type of and broader based set of tariffs. But they'll see. And that's basically what she was saying. We're going to wait and see. Key question for me is how much patience do they have on inflation running hot at a time where they do not want to in any way diminish a labor market that always takes a long time to climb out of downturns.
You were direct about the forecast. How do you bump up your inflation forecast, bump down your unemployment forecast, and cut rates at the same meeting? Now, they keep saying it's a close call. Got to wonder why that was a call at all. Why reduce interest rates against that backdrop?
Mary Daly, President Daly said something else that I thought was really interesting. This idea that we are entering a new phase, and you talked about this quite a bit, but the recalibration phase is over. Next year is a new phase of agility. And what that means is going to be very different than what the Fed has been doing in the past. Key question will be, how do you distinguish agility from data point dependency? Do you get a longer stretch? How do you factor in some of these policies, as you mentioned earlier? Some real interesting questions at a key turning point for the economy.
I would say agility is a fancy word for hyper data dependency.
So I asked for that, actually, and not on camera, and she was saying, and she was happy to talk about this, so I don't think I'm belying any trust, but she basically was saying they have a longer stretch of data to look at if they wait for longer. It becomes difficult, though. How do you message it to a public that's looking for some kind of fall guy?
In the bond market right now, the fall guy for this move, Chairman Powell. Pushing yields up across the curve on Wednesday, yields down across the curve this Friday. We're down 2 basis points on a 10-year to 4.54. On twos, down 3 or 4 to 4.28. Coming up this hour, Matt Miskin of John Hancock on the Fed's chances of landing a soft landing. Zachary Waring of CFRA as a new Nike CEO looks to complete a turnaround. And Subadra Rajappa of SocGen with the market's renewed focus on inflation. We begin this hour with equity futures slipping once again. Lawmakers on Capitol Hill on the verge of a government shutdown and traders preparing for the Fed's preferred inflation gauge, core PCE. Matt Miskin of John Hancock writing, this week was emblematic of why soft landings are so hard to achieve. One could make the argument that inflation coming down, though this through this point, was less about the Federal Reserve and more about supply chains normalizing and energy prices falling. It's hard to see that the Fed is implementing restrictive monetary policy, given financial conditions have been easy as Sunday morning. Matt joins us now for more. Matt, this should be as easy as Sunday morning. Why is this stock market getting hammered over the last few days?
Yeah, we think that the Fed actually was more hawkish, and really when Mary Daly and Powell says it's a close call, I think of an analogy of almost like they're telling you that you almost got hit by a bus and you didn't. Powell's saying, I pulled you away from almost getting hit by a bus by not hiking at all. And we still went through with it, but we're telling you next year, be patient, don't expect a lot of rate cuts, because that summary of economic projections with no cut would have been even more shocking to the markets. Overall, look, we've seen just such a frothy market over the last month or so. There's been $1.5 trillion that have flooded into the crypto space. We've seen a lot of speculative behavior. We needed a dose of medicine here to kind of calm that more speculative, frothy behavior in markets. We think that actually was a good move by the Fed to start to slow down the inflation that was creeping back up. And actually, that could be good as we go into next year of a little bit of a corrective price action. I know it's tough to end the year like this, but it may set you up better for 2025.
Matt, there's a line in your market commentary that sounds suitable to the summer of 2022. I'm not sure how suited it is to now, but I'd love your thoughts on it. For the Fed to get to 2%, they need to hit economic growth. That was the feeling back in 22, that they've got to jack rates up, hit growth, and they've got to cause some pain. The words of Chairman Powell himself. And then we had this supply-side dream, nirvana, take place for the Federal Reserve that took control of the inflation story for them. You alluded to that in the quote that I read out. Matt, why do you think we need to reconsider the 2022 argument into 25?
If you want 2% inflation, it's going to be really hard. And that's the thing. I mean, they keep saying over time. What are we talking, 2026, 2027, that you actually hit your 2% target? And we're running out of patience here. In fact, inflation's starting to refirm. And the other thing with inflation, so it's coming up to close this year, the beginning of each year, there's usually a step up in inflation as there's annual increases that go through. And so as you look at the beginning of next year, you could actually have firming there too. And then the Fed's really going to have to be more hawkish. So there's got to be a sacrifice. And right now, Powell's really excited. And I think most of the FOMC is just very much feeling that they had a victory here because they haven't basically slowed down the economy. They haven't had any weakness in the labor market. And it is good. I'm not trying to say that it's not. But if you want to get it to 2%, it's going to be harder from here. And for us, it looks like they're going to have to be a bit more hawkish. That's going to probably weigh on growth. We go through this cycle in markets over and over again where the markets rally, we get speculative behavior, the rates come up, that weakens growth, that causes markets to weaken. They rebound. It's all over again. This is what we're seeing. It's a late cycle environment. And this is why soft landings are so unusual, historically speaking, because that last little bit of inflation that you want to get down requires usually economic sacrifice. And that might be what we see here into the next couple quarters of 2025.
That said, Matt, it seems like this is a Fed that's willing to be patient in terms of getting those last couple of tenths of a percent off of the inflation reading to get down to 2%. And given that backdrop, does that look good for stocks and bad for bonds?
Prior to this last meeting, that was the case, Lisa. I would agree that they were much more willing to just say, look, if it's around 2 to 3%, we're good. But now as we're getting more towards 3%, and again, there could be a resetting of inflation at the beginning of next year, they clearly are not as okay with it. And I think that's what this last press conference really sounded like. And the FOMC members that are going to be talking here, starting with Mary Daly right before here, is going to be a bit more hawkish. And I think the markets are going to have to digest that. To us, the speculative parts of the markets had this huge rally. We would trim into strength into less profitable, lower quality parts of the market, parts like small cap U.S. stocks, and actually redeploy into higher quality. I know bonds have had a really tough end to the year. It's setting up some nice yield here. We would even consider rebalancing into high quality fixed income.
Matt, what gives you that confidence that now is the time to buy, given the fact that other people are saying, hold on a second, this is a Fed that signaled that it wasn't as comfortable with inflation where it was, but they also increased their expectation for year-end inflation next year and downgraded their expectation for unemployment?
One of my favorite charts of all time. And look, I'm a chart person, so this is big, but it's the whisker chart. So they show the Fed funds rate, and then they show all the projections from the Fed over time. And basically, they're all over the place. They're always wrong. Well, not always, but most of the time they're wrong. And what we see is that these projections are often off. They're just like everybody else. They're just people trying to make their best informed decision or guesses of where things are going. So we wouldn't read into it too much. But what happens is basically the bond market was already pricing in more rate cuts. By giving forward guidance that was more hawkish, they actually are, in a way, hiking rates, because relative to what the bond market had priced in, they're now bringing it up. And now the bond market's only pricing in one cut next year. Before, as much as 4 cuts. So we've seen almost 3 rate cuts put back into the bond market, or taken away, from the bond market and added as a restrictive policy to the economy. And again, because of the frothiness of markets, crypto, everything else, I think it was the right move. We've just got to digest it, be patient into 2025.
Matt, let's just sit on that approach into 2025. I think that you and Lisa are on the same page. Lisa asked this question a lot. What to do when the risk is in the risk-free asset, or at least the perceived risk-free asset? And you've talked about that in your note. What to do when the risk is in the bond market? What are you doing? How are you thinking about changing your approach into 25 with that top of mind?
Yeah, it's tempting to go into credit here. And, like bank loans, short-term credit really has held in well. We are seeing high yield spreads, though, start to rise. So we've seen about 20 basis points rise in high yield spreads. That is, to us, the music, if you will, playing in the background. We don't want to turn up the volume into next year and go more into credit markets. So we're managing that risk. We still have intermediate duration with a mild credit bias, but not really reaching more for credit. The other thing to use is the dollar, and I really like the dollar as another hedge. So when rates are rising, that's going to help raise the dollar. These tariffs we keep hearing about, that's actually usually dollar positive as well. So either bonds or the dollar usually work out for you if equity risk is coming into play. So we've got a dollar overweight expressed across all our views. That's helping here, even though the rate side, it's been harder to use that as a hedge. But I think in the next year, again, one of the biggest things we're seeing is housing is starting to slow. Inventory starting to rise. The biggest inflation concern over time has been housing. If that moderates, inflation comes down. Inflation expectations actually haven't risen that much, another thing. So don't give up on bonds as a hedge or return capital appreciation vehicle into next year. We're going to get about 5% plus in income. That's a great starting point. But we're using the dollar short term as another way to hedge risk over the short term.
Matt, thanks for everything this year, buddy. Appreciate it. Happy Christmas. Matt Miskin there, John Hancock. Merry Christmas and a happy holidays to all of you. 50 minutes to go. Lisa, about 45 minutes to go before we wrap this thing up.
Yeah, I was just listening to Matt and talking about inflation expectations, and I'm thinking, I remember when we used to care about the University of Michigan 5 to 10 year inflation expectations. And guess what?
Hey, don't get loose and easy with we.
Oh, hold on a second. Absolutely not. You've got loose and easy this whole time about we caring about F1. But I will say that we are going to be getting the latest reading on that in just about an hour and I guess 45 minutes.
OK, 10 a.m. Eastern time. Special coverage of you, Mitch, dropping with Lisa.
OK.
No, not sticking around?
If you really... If you stick around to watch, I'll do it.
I am not sticking around for that. I am long gone. In the bond market right now, yields are down by 2 basis points. The 10-year 454. Equities are lower as well on the S&P 500, down by about 0.9%. Some big movers out there. Let's get you one. Here's an update on stories elsewhere with your Bloomberg Brief with Yahara Hacker. Say Yahara.
Hi, John. Shares of Novo Nordisk plunging nearly 20% in the pre-market, wiping out more than $100 billion of market cap in one of the most anticipated drug studies of the year. Novo's experimental weight loss drug, CagriSema, was expected to deliver 25% weight loss. Instead, patients lost only about 20% of their weight after 68 weeks. As a result, you're seeing the maker of Zepbound, Eli Lilly shares rise 6.7% in the pre-market. Meanwhile, Lockheed Martin is on track to meet its goal of delivering at least 100 F-35 jets to the U.S. military this year. This coming as the F-35 program has come under attack by Elon Musk, who thinks manned fighter jets are obsolete. Musk is advising President-elect Donald Trump on cost cutting, and the F-35 has a total $486 billion total acquisition price tag. And Apollo estimates the private credit market could reach $40 trillion within the next 5 years. In an interview with Bloomberg, Apollo's global head of credit product said the firm is seeing growth mostly on the investment grade side, as well as in assets like mortgages, which typically sit on bank balance sheets. And while some are staying away, they're eyeing opportunities in Europe, including in commercial real estate. That's your Bloomberg Brief. John?
Yahara, thank you. What a year for our friends over at Apollo. What a year. That stock up by more than 80% and a big move post-election.
You know, I have to wonder how much this has to do with Mark Rowan and the fact that he was rumored to be in the running for Treasury Secretary, whether that juiced their prospects.
You think? Just a little bit?
I don't know.
I don't know. I think it's the future of asset management.
I think that it could be
they're
combined.
Exactly where the puck was going at the right time.
I don't disagree, but you don't think that it added anything?
No.
Nothing?
No.
Okay.
Just my view. What's my view worth? What's my view worth?
A lot, John. A lot.
Nothing to anybody. Up next, the morning calls, plus the turnaround plans over at Nike. That stock is down by a little more than 6%. We'll get you a view on the other side of this commercial break. From New York, this is Bloomberg. Just got a message from a Bloomberg subscriber. It's that time of the season. Delighted to hear Happy Christmas on US TV. As an Irishman with an American other half, the Happy versus Merry Christmas debate is more ferocious than Fed rate cuts.
That's a good question.
Many of us say happy over in the UK.
Really? You say Happy Christmas?
Happy Christmas and not Merry.
Okay, in the US it's Merry Christmas and Happy Hanukkah because of the alliteration.
So that's, and the Happy Holidays thing.
The Happy Holidays.
Make it super generic.
It's just basically encompass everything.
Not to
Happy
offend
Kwanzaa.
anyone.
But right, so it's sort
Kwanzaa.
of this, all these are other holidays that are celebrated.
People celebrate that?
Yes, absolutely.
Okay, all right. I'm not going to offend anyone on my way out the door. Merry Christmas and a happy holiday to you all. Let's get you some morning calls. First up, Monness Crespi downgrading Oracle to sell, pointing to mounting competition and an unattractive valuation. That stock is down by 1.4%. Next up, JP Morgan raising its price target on FedEx to $370, saying its freight spin-off is not yet priced into shares. That stock is up by more than 7%. And finally, Telsey downgrading Nike to market perform, saying recent results point to a slower turnaround and limited clarity on inventory. That stock is down by 7.5%. Let's stick with Nike. The company reporting second quarter sales and profits exceeding estimates, but a sales slump weighing on its revenue forecasts. Zachary Waring of CFRA maintaining a hold on Nike, but cutting its price target to 80. Zach joins us now for more. Zach, welcome to the program. How long is this turnaround effort going to take in your mind?
Yeah, thanks for having me. We do think it's going to take some time here. You know, the new CEO just got into Nike a couple of months ago. You know, we expect maybe an analyst day or an investors day sometime in the spring or early summer. But yeah, I mean, the guidance was pretty poor. You know, I don't think a lot of analysts or investors thought, gross margins would compress the way that they're guiding for in Q3. So, a little bit of a negative result here to earnings.
It feels like they're trying to go back to the foundation of the company, back to running, back to sports, get back to that and really focus things and narrow it down, and also try and repair what they ultimately damaged, which was some of the channels, including the likes of Foot Locker. How difficult will it be to go back to basics and repair some of those issues?
Yeah, it will be tough. I do think, they're doing a good job now kind of right-sizing inventory. They're working on, kind of limiting inventory for their classic sneakers. Running is doing, surprisingly well. I know a lot of people have talked about, competition from Hoka and On, but, running has been stable for them over the last few quarters. They're even seeing a little bit of growth, and they said they had some growth in women's this quarter. So, a lot of people were worried about On and Hoka and some of that competition. It's still a great company. It's still got, one of the best brands in the world, but they're going through a transition period, and it's going to take some time. So, we've lowered our price target to 80. We've been neutral to negative for a couple of years now. But I think, you're kind of turning a corner here. And I think over the next few quarters, there might be an opportunity to buy shares.
Zach, I have to say, every single day when we talk about Nike, we talk about basketball, and John says, well, isn't the basketball sort of sheen of cool kind of fading? And you see certainly the idea of what you have with viewership going down. And I make the argument maybe some of it's migrating to the WNBA. What's the real story here in terms of Nike's attachment to basketball and what seems to be flagging interest in the sport?
Yeah, and you've seen that, at their Jordan brand. This is, the first year that they've seen Jordan kind of decline over the past 5 or 6. So I do think there is, an issue there, but I think they'll work through that. They've done a really good job of capitalizing on women's sports. They're usually a first mover there. And so, yeah, I think over time they'll be fine. I do think, in the near term, they're going to continue to see revenues decline in that category. But that's, he's focusing on sports and he thinks that's kind of the next leg of growth. I think the issue is now, you've seen China decline. They've been in China for a while. So, how much more growth can they get out of that region? And so it'll be interesting in the next, few quarters to see if they can turn that region around. And is his focus on sports going to pay off? They're in, plenty of sports and they were first movers on a lot of them. So it'll be interesting to see if they can kind of return to growth here.
Is there anyone on your wish list for some of the big sports that they focus and they've arranged their teams into, which is basketball, football, and soccer? Is there anyone who you'd like to be sort of the front man or the front woman for their products who you think could actually make a real big difference? And I know this sounds kind of silly, but sometimes it takes one major star to completely turn around an entire brand.
Yeah, that's tough because they usually do have the biggest in each, in each sport. They've done a good job over the last 25, 30 years to kind of capitalize off of that. And they were obviously the leaders in doing that. So I don't think there's a one single person right now that could, turn things around for them. I think they've got, good strategy in that part of their business. This quarter their marketing expense was up 1% with revenues down 9%. So they're still spending on that side. So it'll be interesting to see over the next few quarters. It's going to be a tough turnaround for Elliott. I think, investors should probably stay patient here and wait for, a better opportunity when you can kind of see the light at the end of the tunnel.
Hey, Zach, appreciate your time. Enjoy the holiday, sir, and have a happy New Year. Thank you. Zachary Waring there of CFRA. Lisa, you're right. I think everyone's looking for that revolutionary athlete all the time. Jordan, basketball, Tiger, golf, Serena, tennis, the likes of Simone Biles, gymnastics. We've seen this on repeat over the years. It might be a struggle right now to find out who that person actually is at the moment.
Sometimes they get in early. It's not just the star that's been established, but you think about what Roger Federer did. You think about some of these other brands that have really grown up around specific athletes that were identified early. It sounds so minor compared with a major billion-dollar company that's dealing with tariffs and everything else, but that's kind of the influencer world that we're in, particularly when it comes to athletic wear.
They just got it so wrong. You and I have talked about this all the time. You walk around the city, go for a walk on the weekend, you see the explosion of these running clubs. Running has absolutely exploded across this country. And then you just look at the sneakers that everyone's running in, and you do not see many Nike swooshes in a way that you used to.
And part of this is because those running clubs, what are the free handouts? I know this sounds silly, the gels and the things, but it's true. They're not there. They're not giving out their products and making a stand.
They haven't been in the game at all. Equity futures on the S&P down here by 0.8%. We'll get some economic data for you in just a moment and get the thoughts from Kathy Bostjancic of Nationwide and Subadra Rajappa of SocGen in just a moment from New York. This is Bloomberg. "60 minutes away from the opening bell and a few seconds away from some economic data in the United States of America. Core PCE, a preferred inflation gauge over at the Federal Reserve, and then a little bit later some special coverage from Lisa at 10 a.m. Eastern Time when she breaks down the UMich consumer sentiment numbers a little bit later.
With hits also contributed by John Farrow, who's going to be joining at 10:30.
10:30?
Yes.
I'm staying an extra 30 minutes later.
Yes, that's correct. That's what's going to happen if I do the special.
Any of that.
We have data.
Equity futures right now in the S&P into this data down about 0.8%. With that data, here's Mike McKee. Good morning, Mike.
Good morning. It's coming out very slowly because I guess a lot of people are looking at this as the last number of the year that matters. And so it's taken a minute to come up, but here we go. Price index on a month-over-month basis up 0.1%, even less than forecast. The forecast was for 0.2, which was what we saw last month. On a year-over-year basis, headline 2.4%. That's up a tick from October, but not as bad as would be forecast. The core up just 0.1%, and the core year-over-year is up 2.8%, same as last month. No increase, even though an increase was expected. Personal income up 0.3 on the month, and personal spending up 0.4. That's a little bit less than anticipated, but does show people are still involved. This is an interesting number because Jay Powell gave us the numbers the other day, but economists didn't all buy into it. It's this most important number because it's the Fed's number for its target, and yet by the time we get to it, everybody kind of knows what it's going to be.
Well, it's breathed some life into the bond market rally. Regardless, we've got another leg lower down in bond yields on a 10-year. We're down 4 or 5 basis points. Looking at this economic data in response to it, down about 6 on a 2-year, back down to 4.25. And off the back of that move in the bond market, equities also just inflecting a little bit higher off session lows. We were down by close to 1% on the S&P earlier in the session. We're now down by just 0.5 on the S&P, and the euro session highs just about back through 104 on euro dollar.
It really highlights just how incredibly sensitive this market is going to be to data points next year, considering the fact that this is a Fed that is agile, that we're looking at this and maybe saying, OK, it's coming down. We might be able to potentially get it. Let's redo everything. No, but it raises this question of how volatile some of these points could be, given how uncertain the economic time is, particularly for economists.
Let's head out to one of those economists. Kathy Bostjancic of Nationwide joins us now. Kathy, welcome to the programme. Let's look at the totality of the economic data so far. Put it all together. Retail sales, S&P Global PMI, jobless claims, the data we just got. What's the picture look like from your vantage point?
Good morning, John. Happy to be with you. Well, the economy is strong. I mean, we're ending the year with growth somewhere, close to 3% annualized for GDP. And that momentum a large part of that will continue into the new year. And we just went through the income and consumer spending numbers. They're solid. They show that consumers have the wherewithal to spend because they're getting the income to support the spending. And that, at the end of the day, that's really what will drive consumer spending the most. Now, the wealth effect on top of that also turbocharges things. 20% plus gains in the equity market the last 2 years, that and home prices being up over 50% since the pandemic, that also turbocharges things. Now, on the inflation front, really, these are very good readings. And I think somewhat surprising, as you mentioned, coming on the heels of what people thought was maybe a less dovish Fed reaction function, right, on Wednesday. But up a tenth. These are great numbers and better than some feared. So, what does the Fed do with all of this? I still think they pause early next year, but I think they're underlying, there's disinflationary forces here. What we don't know is what happens on the policy front.
Kathy, I'd love your thoughts on an issue that Lisa has raised a few times since Chairman Powell spoke on Wednesday, and you can see it playing out in the market right now. There's some nervousness in equities and amongst investors that maybe the Fed's easing bias is being disrupted by the incoming inflation data. And you can see just a little bit of relief on the margin off the back of these numbers this morning. Seeing equities start to bounce, bonds rally just a little bit more. What's your view on that? How disruptive has the Fed's easing bias been over the past few months?
Well, they still have an easing bias. Chair Powell made that very clear in the press conference. And you see that, they're still penciling in some rate cuts next year. It's just that it was 2, not 3 or 4. So the easing bias is still there. The question, to me, is does inflation get in the way of that easing bias? Does it get them to be more cautious? I do think the bar for easing has been raised. So they still have the easing bias, but that bar has been raised. And because we have uncertainty of what's going to happen, particularly on the tariff front and immigration, does that filter through to significantly higher inflation? Does the Fed look through that? These are one-off price increases or something more worrisome? That's where there's, I think, right now, this uncertainty.
Kathy, I remember when we used to care for a minute, this was actually one of the main indicators that Fed Chair Jay Powell himself was looking at, and that is inflation expectations. The University of Michigan 5 to 10-year inflation expectations that I'll be breaking down at 10 a.m. I will not be breaking them down at 10 a.m. Michael McKee will be breaking them down. But I do wonder if that's going to become really important now. This idea that if there is an entrenchment of inflation expectations among consumers, that will change the outlook for the Fed in a material way.
Oh yeah, they're always important. I would say, even more so than the market expectations. Consumer expectations, really important, and those long-term, as you said, 5 to 10 year. As long as they're relatively anchored, the Fed, has comfort. What they don't want to see is, a sharp increase in those 5 to 10 year. But the 1 year expectation, that could be moved around by food, energy, slightly higher prices temporarily. But if the long-term stay anchored, that gives them comfort.
How much within the data that we've already seen are we seeing a stabilizing in terms of personal expenditures? We also got personal income and spending, and you were talking about how that continues to be robust. Personal incomes have been rising on a real basis. At the same time, we hear from retailers a lot of spotty types of performance, maybe cautious consumers. Have you noticed any trend? Are we inflecting back upward, or have we really declined in terms of the dynamism of the U.S. spender?
Certainly the consumers are price conscious, and certainly if you break it down among the income quintile, as you move down, middle income, lower income households, very price conscious. I think upper income households, as I mentioned before, if you're an asset holder and your wage gains are more than keeping pace with inflation, you're feeling pretty flush right now in your spending, and you're traveling and you're dining out. So that's really propelling things here. We're coming off remarkable 3 years, really, of strong consumer spending that's propelled the economy. Now, that said, I do think we moderate a bit. It is really tough to continue to see this type of strong growth well above underlying potential at a time, and I think here's the key, the labor market is still solid and strong. It's churning out jobs and income, but it's pretty concentrated. If you look at the cyclical sectors of the labor market, they're not generating any net new job growth. And I think that's what you hear from Chairman Powell and others, that cyclically they are a little bit concerned we could get a slowdown, and they just don't want it to be too much.
Kathy, that's an important perspective. And we appreciate your time and your contributions this year. Thank you. Enjoy the holidays. Kathy Bostjancic there of Nationwide. That last point's really important. The cyclical areas of the labour market, we've seen quite limited growth there. Housing, autos has been a bit of a struggle as well. And you just wonder if the Federal Reserve's going to keep on working off the aggregate, the headline number, which is what they're charged in doing. So you're going to see GDP that's robust, unemployment around 4%. Then that bifurcation we've seen in that economy, that disparity between the haves and the have-nots is going to become greater and greater in the year to come.
Which raises this question, which is the worse evil? The idea of hiking rates or keeping rates high to torpedo the economy and cause that unemployment rate to rise, is that worse? Or is inflation that also is most punitive for those people on the lower end of the income sphere who might be more susceptible? It is sort of choosing between the two evils.
Mike, you're getting a second look at these numbers. What jumps out to you?
A couple of interesting things. One is that personal income rose significantly, both in October and November. October revised up to a 0.7 gain, 0.3 in personal income overall for the month of November, but wages and salaries were up 0.6, the most in at least 6 to 8 months here. So Americans taking home more money. It was the people who get dividends and stock payments, interest payments, who didn't quite get as much this time. Savings rate goes down to 4.4% from 4.5%. So we're still seeing people putting money away, and that's not going away. That helps a lot overall. So at this point, this looks like a pretty good number. And of course, the PCE inflation index, very low, 0.128. So it really does show progress in what the Fed is looking for in its main number.
Pushes bond yields down a bit more as well. Off the back of this data, we're down 5 basis points on 10s, 451. On 2s, down 5 or 6 to 426. Subadra Rajappa of SocGen with us around the table. Subadra, good morning.
Good morning.
I think before the Federal Reserve, you had 2s going down to something like 350 at the front end of the curve. Has that changed since you heard from Chairman Powell?
350 for the end of next year. So we don't really, I mean, we are anticipating more cuts next year. Our economists really haven't changed their call for the Fed because we just don't have much by way of new information. Yes, the Fed, the committee itself recalibrated to just 2 cuts for next year. But the way the economy has been going, you should see a moderation in growth. You should see a moderation in employment. You should see a moderation in inflation. And under the circumstances, the Fed might be able to deliver 4 cuts. But as a rate strategist, my bias is that they deliver less cuts. So the market is very, very efficiently priced in for a very benign policy path. But if they do deliver 4 cuts and aligned with our economists' call, then the 2-year could end the year next year around 3.5%.
Interesting. We've had a robust debate around this table over the last few days about what was behind and what underpinned those changes to the forecast of the Federal Reserve, the data or Trump. We're teasing out some of that information from officials on the FOMC. Mary Daly, the San Francisco Fed president, told us about an hour ago that for her it was the data. But for others, it was clear that it was also about the policies.
Yeah.
What is it for you? What are you basing your calls on?
So I think it's going to be a bit of both, and I think it's going to be a constant recalibration process as we get new information hitting the tapes. And there's going to be a lot of that 3 a.m. tweets that we have to respond to next year, so we're all getting ready for that. But it's going to be quite difficult depending on how the tariffs are rolled out. I mean, last go around, tariffs were over a 2-year period, and on sometimes on very specific products. This time, it could be much more of a sweeping tariff regime. So we're going to have to recalibrate as the data comes in. I mean, the Fed, I think, as we heard from Chair Powell, some of the Fed members are already incorporating some of the changes that could come down the pike, and others are not. And that's exactly what you're seeing among street economists.
What's your reaction function to the tweets?
It's funny because I'm now mentally preparing myself to wake up in the morning to stuff that I was not prepared for and then having to react very quickly. And our counterparts in Asia especially are looking forward to it because they can react to the volatility as it's happening because they're awake at 3 a.m. New York time to respond to the incoming news. So, it's going to be interesting. It's just a paradigm shift to where we were between 2016 and 2020.
So things are going to get pretty noisy, right? I mean, it's sort of a question of do you get more tactical or long term, and how much is this increasingly a tactical market because of how obscured what's going on underneath actually is?
Yeah, no, it's going to be a very tactical market. We're going to have to constantly recalibrate. Just look at the last 2 days. We've gone back and forth on whether there's going to be government shutdown or not, based on information from either the Trump aides or from Trump. So you're going to need to see that it's going to be a lot of back and forth like that for the next 2 years and then perhaps even the next 4 years.
Things really are obvious. If you just take the example of this morning, we've all woken up to this post from the president-elect on Truth Social suggesting that if the Europeans don't close the trade deficit and buy more LNG, there'll be tariffs. I don't think it's clear what happens with that at all. The Europeans have already come out ahead of time and said we want to buy that LNG. I think Ollie Crook said a little bit earlier, referencing one of our colleagues, that they're pushing on an open door. At the moment. They want that to happen.
Of course.
There's an outstanding question whether that's enough to close the trade deficit and whether if they don't, whether you actually get those tariffs. So I don't think anything's clear before you even begin to assess how inflationary or not those tariffs would actually be. There is nothing cut and dry about 25 and beyond.
Especially given the fact that even the reaction in markets, the reaction in the economy will look different, given that we're coming from a very different starting point. And I think about right now, you're talking about a government shutdown, and we did get a tweet from Donald Trump saying that let's shut it down now before I get into office, because then that's on his head, not my head. And I'm just wondering, what's the response to that in the fixed income market?
So I think that you're right in pointing out that the starting point is very, very different. And I'm really concerned about that from the inflation perspective because, between 2016 and 2020, inflation was not a concern. I mean, we had like maybe a 2-year decade period when, core CPI, core PCE never really exceeded that 2 to 2.5% level. Now our starting point is a lot higher. You're looking at core PCE around 2.8%. The economy is extraordinarily vulnerable to inflationary shocks on the services side. So I think that is really the game changer this time around, is that if you do see tweets and the market reacts and thinks that it's going to be inflationary, then you're going to see the volatility in inflation expectations. So the break-even market is not really priced for that. So I'm expecting a lot more volatility in inflation break-evens next year because of the fact that we're in a very different inflation regime this time around as opposed to back in, the Trump 1.0 timeframe.
Subadra, it's good to see you. It's great to catch up. Appreciate your time. Thank you. Subadra Rajappa there of SocGen. Your equity market recovers just a touch. We're down by 0.5% on a 3-day slide. Lisa, very close to making that day 4.
Yeah, a real question here about whether this is just sort of end-of-year rebalancing or whether this is a structural shift with the shift from recalibration to a new phase from the Fed and potentially a real example of the volatility in Washington, D.C.
That new phase is we haven't got a clue.
That's correct.
Into New Year.
That's right. That's
the new phase.
It's agility.
Still trying to brand it, but ultimately that's the essence
that's your branding?
of it. That's the essence of it. That's not my branding. I'm just saying that's the essence of it. You can come up with a better name.
Okay.
Got 2 weeks. I'll see you in the new year.
Okay.
All right, let's get you an update on stories elsewhere. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Staying on Washington, media reports suggesting the House is working on another plan to avoid a government shutdown. Fox News reporting members will meet at 10 a.m. on a temporary fix, while NBC News is reporting Speaker Mike Johnson expects votes later today. President-elect Donald Trump also taking to Truth Social, saying, quote, if there is going to be a shutdown, let it begin now. Government funding is set to expire tonight at midnight. Meanwhile, the FAA has banned drone flights over several parts of New Jersey as sightings of mysterious aircraft continue. The agency has temporarily published 22 flight restrictions over critical infrastructure in the state, which it says was at the request of federal security partners. The announcement comes just a day after the FAA warned people that pointing lasers at aircraft is illegal after seeing a dramatic increase this month in pilots reporting those types of incidents. And the Philadelphia City Council voted to approve the construction of a new downtown arena for the 76ers. The $1.3 billion plan had met fierce local opposition from residents claiming the arena would devastate small business and landmarks in the city's Chinatown. Mayor Sherelle Parker has maintained the project will create thousands of jobs and help revitalize the area. That's your Bloomberg brief. John?
Yahara, thank you. Thanks for this morning. You've got a name, have you? What have you got?
Choose Your Own Adventure.
Choose Your Own Adventure.
Yeah. Because
okay.
Did you ever read those books? If you think that they should do this, turn to page 69.
All right. Sabadra's nodding along.
You know exactly. You agree.
Exactly.
Okay. Yeah, okay.
I think that's exactly what it is.
There you go. Subadra, thank you for everything this year as well. Thank you. Happy holidays. Appreciate it. Next on the programme, we'll set you up for the week ahead. You are watching Bloomberg TV. The opening bout 39 minutes away. Equities attempting to recover on a 3-day slide and trying to avoid making it day 4. Equities on the S&P 500 negative by 0.6%, down on the Nasdaq by 0.9, and off on the Russell by 0.7. With your morning movers, let's cross over to Manus Cranny. Hey, Manus.
Jonathan, good morning. A humbling moment for Novo Nordisk. One of the new experimental weight loss drugs simply hasn't hit the benchmark. It's a new weight loss drug. It's called CagriSema. Now, CagriSema, basically, the promise was you'd lose 25% of your overall weight over 68 weeks. That comes in at 22.7. That is a disappointment to the extent of $120 billion of a wipeout, 30% of value. So that is a humbling moment. We've come off those lows. It's all about defending your market share against Eli Lilly. Of course, their bid this morning on the back of the disappointment for Novo. That market's going to be worth $130 billion by the end of the decade. FedEx, divide, monetize, maximize shareholder value. I told you I've got a future in PR for these companies. FedEx, they're going to spin off the freight unit. BI have run the numbers. They reckon it's worth about $30 billion. It'll happen probably in the next 18 months. It allows them to focus on the core business, which I can tell you is the canary in the coal mine of delivery, because here in the United States of America, demand for the express business is light, especially in the United States of America. Nike, low double-digit growth. The ghost of John Donahoe lies over this particular stock, Jonathan. Elliott Hill came out of retirement. This was his moment to tank everything, all the stock he didn't want, and draw a clear blue line between him and his predecessor. Bloomberg opinions say he missed that moment, he missed that opportunity. They're guiding low double-digit growth. This was your moment to say, now, that's your stock, that's your inventory, that's your problem. I've got a plan. It's a global plan. I'm going to re-premiumize Nike. Jonathan, happy holidays.
Thank you. Happy holidays to you too, sir. Appreciate it. As we count you down to the holidays and the opening bell, your trading diary through the weekend and into next week looks like this. At 10 o'clock Eastern Time, UMich sentiment, 12 a.m., the deadline to avoid a government shutdown. Monday, consumer confidence. Tuesday, durable goods. Wednesday, US markets are closed for Christmas Day. Congress, of course, racing to prevent a government shutdown as we go into the weekend. Anne-Marie is joining us now from Washington, D.C. AMH, what is the latest? How close are we to a government shutdown?
Well, there's still so many questions swirling around Capitol Hill and whether or not we are going to be shutting down. You wake up this morning and you thought potentially that was what I was looking at, 12:01. There was going to be a government shutdown. And then we have House Speaker Mike Johnson coming into the Capitol saying, we've got a plan and expect votes this morning. The issue is there's no bill that's been filed yet. So what exactly would he be bringing to the floor? Do we just not see it yet? Or potentially is he going to try the bill that failed yesterday? Maybe if he was able to get those 38 Republicans that voted against it to say yes. Lots of questions, not a lot of answers right now, and time is of the essence. We could be headed for a shutdown just before the holidays.
Anne-Marie, why not just pass something, push the can down the road like they always are going to anyway, and let us all go on vacation without the worries of extra delays because TSA workers won't be getting paid?
Well, the thing is, they might end up coming to that. It might just end up being, as Doug Rediker put it to me, the cleanest of cleanest CRs, literally just kick the can down the road. The problem is President-elect Trump injected himself into this problem, which also says to me, did Speaker Johnson have his buy-in for the bill that he originally wanted to put on the floor, that he negotiated with Democrats? Because it doesn't seem like President-elect Trump wanted that. It seems like President-elect Trump wants to clear the decks before next year. He doesn't want to deal with any of this, including the debt limit, which will become an issue starting in January. And his inauguration is January 20th. So it doesn't seem like they got the buy-in from President Trump, and that's causing a lot of problems right now for the Speaker.
We've got to clear the decks right now. Anne-Marie, I know you're taking over next week and you're not going into the holidays, but for Lisa and me, we are. AMH, thank you for everything this year. Happy
Merry
holidays
Christmas.
to you. We'll talk on the phone later. Thank you. Thank you very much. Bramo, that does it for us.
Yeah,
Going into year end.
I like to say, you're just rubbing it in. You'll be here.
No,
have a great time. We're gone.
AMH would have pointed that out for me.
Exactly. Well, the truth is, have a wonderful, wonderful holiday. I will say this has been quite the year.
Hasn't it just?
I mean, it feels like about 10 years, and
I know.
Probably let's hope for a calmer year next year.
I know I've said this already this year, but thank you to you at home. I think we all consider you, what I say all the time, to be the most intelligent audience anywhere on the planet. And thank you to everyone in this building for making this program happen. There's a lot of work that goes on in the kitchen. We just get the honour of serving the food. Thank you. Have a very happy holiday at home with the family. And I look forward to seeing you all in the new year. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.